Good morning. It is Friday, the 13th of January. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith, Brian Sazzi. They're working in the kitchen studio today. Let's get a check on the markets on this busy earnings Friday. And Brad, we have futures indicating a lower open and really rolling over as the earnings started rolling in, right?
Yeah, banks, airlines, we're going to get to all of them this morning. But taking a look at the futures across the board, you've got the S&P 500 futures down by about 1% right now. We're also taking a look here.
We're going to take a look at some of our trending tickers because a lot of them intersect with this earnings thing that we're watching. And we're going to talk in much more detail about the earnings. But I wanted to give a quick tour of what we were seeing. This number in the red is what we're seeing in pre-market from Bank of America, down more than 1.5%. JP Morgan Chase down 2.25%. Delta, which you're watching closely, those shares are down by 5%, Brad.
Yeah, a lot to break down there. Earnings season has officially kicked off with the major banks posting their fourth quarter results. Let's start things off, though, with JP Morgan. The company posted a beat on earnings and revenue, but CEO Jamie Dimon warned of further economic uncertainty ahead as the Fed continues its rate hike cycle. And there you're taking a look at some of the actuals versus the estimates. Beat on top and bottom, but what I was looking through here with regard to what the company was saying and what JP Morgan and the CEO and the leadership particularly are pointing out at this time, really looking across some of the businesses, and it's really coming back to the extent of the recession that they're modeling for. And we've heard everything in how CEO Jamie Dimon has classified this in the past to using the hurricane analogy, and then even now looking like they're anticipating more of a mild recession. And so that is something that they're going to be modeling for in the near term. And of course, it ranges across some of their businesses. But again, just coming back to the quantitative tightening that they're citing here, unprecedented quantitative tightening is what they had pointed to here, Jamie Dimon saying in a statement there. And then additionally, they're still looking at some of the headwinds coming from geopolitical tensions as well, including the war in Ukraine, plus the vulnerable state of energy and food supplies. So net, they're kind of looking at some of the macroeconomic conditions and saying we're not out of the woods just yet, and not even close to it, really.
Yeah, no, Brad, I'm glad you brought that up because it is, it's not, we shouldn't be downplaying this. I have not seen in the past 7 or 8 years, or maybe even going back to the great financial crisis, JP Morgan step up here on earnings day and in the bottom of the, or I would say midway through the earnings release, say their central case, or as they say on Wall Street, their base case for this year is a mild recession. That means they are planning their business under the assumption that growth worsens from the fourth quarter and we see contraction in growth at some point this year, maybe in the first half, unclear what they're looking for in the second half. That is a major red flag, I would say, for a lot of other companies and how things may shape up this earnings season. I think it's playing a large part on driving the shares under pressure here in the pre-market. And then in addition, we've been really hearing over the past 2-3 weeks a lot of these investment banking layoffs that are now starting to sweep Wall Street. And you look at JP Morgan, investment banking sales down, volume sales down 57%. That is another jarring year-over-year decline, follows a decline in the third quarter, in large part because the market slowed down. You have rising interest rates, deals are being put off, whatever it is. This was not a typical, I would argue, not a typical rosy or upbeat JP Morgan earnings day.
Okay, and then just one more thing I got to say about JP Morgan as we see the stock down. It seems to be because of the forecast for net interest income. That seems to be what's to blame perhaps for the decline. Listen, all these guys are going to talk about what's going on in the broader economy. The stock doesn't necessarily usually move because of the macro comments they made. Sometimes it does to some extent, but they're saying for that net interest income will be about $73 billion this year. Estimates were for $74.4 billion. So that in a rising interest rate environment, to see that net interest income forecast fall below what analysts were anticipating, that should give folks pause. Let's talk about Bank of America as well, because we got a lot to get through this morning. Their net interest income in the past quarter was up by 29% to $14.7 billion. That, however, was a little bit short of what analysts had been predicting. Trading revenue helped make up for some of that shortfall in net interest income. It was up 27% to about $3.72 billion. In particular, fixed income for Bank of America performed well. It was up by 49% in terms of the revenue. Investment banking revenue was down by 54%. We're going to see investment banking really get hit probably at a lot of the banks. They're seeing lower fees from things like mergers and acquisitions, for example, and underwriting as well. So that's something to keep in mind. Now, CEO Brian Moynihan did strike an upbeat tone in their statement. Their conference call is not for another 25 minutes. So if he makes any more pessimistic comments on the economy, we'll have to wait until then. But he did talk about ending the year on a strong note. The themes in the quarter have been consistent all year: organic growth and rates helping deliver the value of our deposit franchise. A couple other things to mention when we I know we're closely watching headcount and potential job reductions at the banks. It sounds like that is not in the cards for Bank of America, at least not at any large scale. The company's CFO, Alistair Borthwick, saying the company has no plans for massive job cuts. And indeed, if you look at their headcount numbers, you'll see that they didn't see any reductions. In fact, they grew overall headcount above 216,000 in the quarter. They had 208,000 folks a year earlier. So those are some of the headlines and highlights that I am watching right now, you guys, from Bank of America.
And that's what you get from Brian Moynihan and Bank of America, guys, a really well-run bank and not having to do a lot of layoffs. But switching gears for me, I'm monitoring Wells Fargo here. The bank, I think in some of the early commentary I've seen out there, everyone, getting some high marks for the charge-offs or litigation-related expenses. That looks to be slowing down compared to prior quarters, which is interesting to see. Of course, Wells Fargo has been battling various legal issues for some time, and Charlie Scharf, the CEO of the company, has had to come in there really, and it's been hard for him to orchestrate any turnaround plan because he has had to deal with these legacy issues. So that reversal or that trend improvement, which may be beginning in the first half of this year on litigation reserves, is very important. And then, we were just talking about JP Morgan calling out a mild recession this year. I hopped on a media call this morning with Wells Fargo CFO Mike Santomassimo. He did tell me that he's preparing for the economy to get worse over the next couple quarters compared to the prior few quarters. You have JP Morgan calling out a base case of a central recession. You have Wells Fargo CFO looking for the economy to worsen. And wow, guys, this is definitely, I would say, a change in tone from some of these banks, excluding Bank of America, like you mentioned, Julie, but a change in tone by some big banks to kick off this earnings season.
Yeah, definitely. So I'm looking at the tone coming over at Citigroup. The CEO, Jane Fraser, there saying, "We intentionally designed a strategy that can deliver for our shareholders in different environments, and we are very much on track to reach the medium-term return targets we shared on Investor Day," she says. If you look at the numbers here from the bank, you see earnings per share missing by a little bit, and in particular, revenue from equities trading falling short of analyst expectations, fixed income trading revenue, however, topping estimates. So that's something to watch as well. Investment banking revenue here, another decline for these banks that were pretty much going to probably see across the board, down 58% in the case of Bank of America. That revenue figure we just showed of about $18 billion was a 5.8% increase on a year-over-year basis. So those are some of the themes that we are watching from Citigroup. Those shares are little change, just down about a tenth of 1%, I think we were looking at there for just a sec. We're going to keep looking through all of these as well as keep telling you about the reactions to them, Saz.
Julie, are we done with earnings? I'm out of breath here. I can't keep up.
Well, you got to keep up. You of anyone, you're the one keeping up. You're doing great, Saz.
All right, I appreciate that confidence. All right, well, let's stay on earnings. Delta Airlines posted better than expected earnings in the fourth quarter, marking its first profitable year since before COVID-19. But the airline missed on its first quarter earnings forecast as its new deal with its pilots union is set to weigh on its profitability. And Brad, I know you follow this name very closely, so I'll hand it off to you in a sec. But really what stood out to me, the company looking for $5 to $6 a share in EPS this year. The street was about $5.07. Good to see that guidance from Delta. And again, and I think we talked about this a month or so ago when we heard from Delta, still looking for that $7 in earnings per share number in 2024. So reaffirming that outlook.
Yeah, and you mentioned off the top there that it really comes back to what they're forecasting for this current quarter that we're in right now, especially as they're citing this continued favorable demand that Delta is seeing. And they've continued to give us kind of this comparison versus 2019, which was the last time that we had seen levels, capacity at kind of full pre-pandemic levels. And so if we're still looking at that comparison for the current quarter that we're in right now, where they're forecasting this range, an EPS of about 15 to 40 cents, You compare that to 2019's first quarter, they saw 96 cents. And so the street probably continuing to look at that and utilize that pre-pandemic comparison, as that's been the barometer that Delta has continued to point back to. But as you continue to hear from the CEO of Delta, Ed Bastian, he had said within this release, as they move into 2023, the industry backdrop for air travel remains favorable. Delta well positioned to deliver significant earnings. Those earnings we just broke down, but then it's also about what costs they're anticipating. And you also mentioned that a moment ago, Saz, as well. It's this pilot package that has been kind of negotiated, but then also agreed upon, at least in principle, where they're looking for these tranches to eventually add up to about 34% in increased compensation for pilots. And so once all of that is finalized, as long as all of that is approved as written, I think that's significantly what CFO Brian Jenke was pointing out within this release as well, and giving a nod to some of the increased costs that they're anticipating too.
Right, even as fuel costs abate to some extent, made up for, and then some perhaps, by those higher employment costs. And it's important. You want the person who's flying your plane to be well compensated.
Give them what they want.
Hell yeah.
I think that
Hell
is
Give them whatever they want.
to say.
Give them free food, give them vacation time. Oh my God, you kidding me? We love those guys.
All right, moving on to another way that people get around this one. It's going down in price. Tesla is slashing prices of its electric vehicles in the U.S. and in major European markets as the company looks to boost demand. The move comes on the heels of recent cuts in China, Japan, and South Korea as competition in the EV market grows. Yahoo Finance's Pras Subramanian joins us now with more details. And Pras, this also has to do with the Inflation Reduction Act and the various credits that people are eligible for. Couldn't look for the word eligible when we're talking about these price cuts.
Yeah, that is the big factor there. And, we had heard reports of inventory building up, new inventory building up since the first of this year, because people were waiting for those price cuts. They knew they're going to happen because the way that Treasury had laid them out, it didn't really make sense. So here we are with these new price cuts. So I want to start off with a couple notable ones here. The Model 3 performance from $62,900 to $53,900. Now, this is one of the cars that has that $55,000 price cap,
That's
right?
a big reduction.
That's a huge one, especially for a car that's already sort of relatively cheap as an EV. And then the Model Y, right? The Model Y performance you see there, $69,900 to $56,900. Now that cap is still $55K for that car, the 5-seat variant. And then now here the Model Y long-range all-wheel drive, $65,900 to $52,900. Now it is below that $55K cap for those tax credits. So that car, when you add that $7,500 tax credit, that goes on around $45,000, right?
I have a quick follow-up question. These are starting prices, right?
Correct. Yeah.
So like if you get all-wheel drive on the 3, that's another $10,000 on top of that.
Well,
do the credits apply to the base price, or do they apply to the total price?
So the base Model 3 was already below, was at $46,900. It was already below, so that went to $43,900, I believe.
Got it.
This was the all-wheel drive performance, and that was above the $55K. Now it's below it, so now it's going to qualify it. So we're going to see people kind of come in now and probably start launching in those orders. People cancel orders too at the end of the year because they thought this was going to happen, right? So we're going to see those orders come. We're going to see probably big delivery numbers in Q1. But the big question is, and people like Dan and I have talking about this is the right medicine at the right time. But the big question is, what happens to those margins, right? They're going to come down tremendously, and that's going to be probably a big discussion on the call on January 25th.
Okay, and so this also begs the question of what happens for consumers who are now looking across some of the other options that have either made their way into the market already or are available for orders, and then they decide to take delivery elsewhere because they can offset what they're paying in the deposit by just taking delivery on some other car somewhere else.
Yeah, I mean, if you're cross-shopping Ford Mustang Mach-E, you're cross-shopping the Volkswagen ID4, the Tesla Model Y and Tesla Model 3 become infinitely more compelling at these price levels, right, compared to those. I mean, those cars will also qualify for that price, those tax credits. So it just makes the Tesla equation much more, a better equation for consumers at this point. I mean, the question is like that's pure profit that's getting cut, right? That's really bad for them.
Well, and to your point, it might be good for consumers and not great for Tesla. I mean, Tesla had that terrible year last year. This year, it's up 0.3% so far. So it's not, in other words, it has not seen a big rebound. Yeah. And we are sort of digging into what happened with the company and what's going to happen next. Yahoo Finance actually had the chance to speak to economist Paul Krugman, who's also, of course, a New York Times columnist about Tesla. He's been writing about it a lot. And he explained why he thinks it's never going to be at the same level as other tech giants from a real perspective.
Tesla is not going to be Microsoft, even if everything goes the way it should. It's not going to be Apple. This is not a network externalities, as the economics jargon, where basically people use something because everybody else is using it, and it's very hard to break out of it. And so you get decades of extremely high profits. The car industry is not like that.
So effectively saying it's overvalued, and that's why part of the reason why it's come down so much.
Well, yeah, I mean, it was the kind of industry leader, the pioneer, and it got that attractive valuation for so many years. And now it's saying, you know what, you guys are just like GM, Ford, and Volkswagen. You're making electric cars, good margin, but not astronomical valuation. So I think Paul Krugman is kind of right in that sense that it's not a software high margin company. It's going to become like a regular sort of industrial car maker. But if you're asking Elon Musk, he'll say, my software is better than anyone else's. We have the suite that we can make. We can actually add that margin back in software.
I mean, it's almost like it's a victim of his own success because the goal is for it to be a mass product. But when it's a mass product, the margins come down.
Yeah.
Because it can only be a mass product by being affordable to a large number of people.
Absolutely.
Yeah.
We're going to have much more on this. Yahoo Finance's own Pras Subramanian actually going to join us during the 11 a.m. hour as well. Be sure to tune in for the entire hour. We're going to be taking a deep dive into Tesla's stock crash and the road ahead for the EV maker. That's in our latest installment of What Just Happened, where we explain the top trending story of each week. You don't want to miss that. And coming up as well, we got to get to this story too that we've been tracking. Bed Bath & Beyond is reportedly in talks with Sycamore Partners to sell its assets. New York Times' Deal Book is reporting this, and this includes its Bye Bye Baby stores. And the retailer is also in talks with other suitors about possible deals. This news comes as Bed Bath & Beyond navigates a possible bankruptcy process. Bye Bye Baby has been one of the brighter spots in the parent company's downfall as it maintained its relevance in a very defined market. A spokesperson for Bed Bath & Beyond reiterated to DealBook that multiple paths are being explored. Well, coming up, we're going to do a deeper dive into those big bank earnings with an analyst from S&P Global next. Earnings season kicked off with a bang today after big banks, JP Morgan, Citigroup, Wells Fargo, and Bank of America all reported earnings this morning. Here to break down those numbers is S&P Global Market Intelligence Director Nathan Stovall. Nathan, great to have you here with us. If we're kind of painting a broad stroke across some of the bank earnings this morning and extrapolating one thing that could be an underlying theme or a common denominator for the rest of the earnings season, what do you think that might be?
I think it really comes to the outlook. We thought Q4 was going to be pretty strong, and the results that have come in have supported that. We've seen strong revenue growth pretty across the board, strong loan growth, continued increases in deposit costs, but again, that was expected. But also really, really strong credit quality, no real deterioration yet. But the question was going to be, what was the outlook going forward? And what we've seen is not anything really negative, but as you were talking about earlier in the show, the outlook that now JP Morgan is baking in that expectation for a mild recession. So slower growth going forward, higher credit costs going forward. And I don't think it's necessarily that much negative, but you got to look at what the group was trading on leading up to this. Bank stocks had taken pretty great pressure most of 22, but we had seen a little bit of a rebound with perhaps the hope that maybe the Fed would pivot with the idea that they wouldn't want to push the economy into a recession. And now you've got some big bank executives saying that that is becoming sort of their base case. So going forward, I think that's really what the street is going to be focused on. What is the outlook for credit and really the broader economy going forward? I wouldn't say that it's necessarily that dire, but investors are hoping that it would be sort of continued blue skies.
So Nathan, if these stocks are going to trade off that recession call by JP Morgan and to a lesser extent Wells Fargo, so do you see more downside in the coming weeks to these names?
Well, when you look at where they're trading at historically, they're pretty cheap, arguably. So you could argue right now that the expectation for a recession is built in. We just had seen a little bit of a rebound in some of these names, JPM in particular. So when they come out and they throw out the expectation that you're going to see slower growth coming forward, I think that weighs on the name. But even more so, and you had mentioned this earlier on the show, the net interest income guidance came in a little bit lighter than was expected. And I think that that's a little bit weight on the stock too. But it really is going to be, what is the outlook relative to where people thought? Any sort of bit of bad news that kind of supports that negative bear case for the group, I think will add to some pressure. But it's not necessarily going to put severe pressure on the group.
Nathan, it's Julie here. The theory is, right, is that rising rates help the banks, right? That the net interest income tends to expand at times like this, even if the economy is slowing and that hits, say, deposit growth or loan growth. So talk to us about how you're thinking about how most of the banks have to balance those two this year and whether they're going to be successful.
Sure. And that's the name of the game. I mean, higher rates are good for banks, and we're seeing that play out in Q4. And ultimately, we think fundamental trends look pretty strong. But that balance of loans growing at a much quicker pace than deposits, and deposits even sort of flowing out of the bank, is the challenge that the bankers have right now. And we're starting to see liquidity pressures arise, and that has been sort of the biggest thing and talking point that we've had over the last few weeks, not only in terms of deposit costs going higher, and we did see that play through on these big banks' results, but also the idea that maybe liquidity will be a little bit more fleeting. And we think that will continue to play out over 23, though we're not really in the camp that it's going to be as negative as some. So yes, there will be some outliers, but ultimately we've been in the camp that what you will see is that deposit rates will continue to go higher. That's good for consumers, but it's bad for bank margins. And so you get to a place where bank margins peak sometime this year. And thus far, we haven't really gotten any real clear read through to that, but the net interest income guidance from JP Morgan sort of supports that thinking that we're getting closer to a peak soon. And the banks that are able to kind of buck that trend and really hold the line on deposit cost are going to be ones that really significantly outperform going forward.
And you see JP Morgan on that screen trading off, like you mentioned, I think, Nathan, on fears about a recession and how their first half results might pan out. Nathan Stovall, S&P Global Market Intelligence Director of Financial Institution Research. We'll let you get back on those earnings calls. We'll talk to you soon.
Thank you.
All right, here's a name I'm really excited about for earnings this morning. United Health, so a 12% boost in revenue for the fourth quarter. We'll discuss that, plus have the opening bell on Wall Street next. Welcome back. Let's take a look at what's trending on the Yahoo Finance platform this morning. Started with United Health following an earnings beat on the top and bottom lines for the fourth quarter as revenue grew 12% year over year. And guys, another quarter from United Health, another very good one. You had net margins up about 30 basis points year over year. Sales up, like I just mentioned, close to 12%. Overall, a good year for this company, a year where they saw sales up 19%. Pretty impressive.
Yeah. Solid cash flows from the operation there. You saw that coming in at about $26.2 billion. I mean, this year is one where for healthcare, or at least coming off of last year, there's a larger question of how much that tailwind that they could ride off of people leveraging some of their healthcare and insurance plans and opting into either some of the procedures that they had to put off, or just making sure that they were getting the regular checkups that perhaps were part of routine prior to the pandemic. I think that's exactly where United Health and some of the other insurance plays have been able to benefit over that period of time as well.
Yeah, as always with United Health or any of the big insurers, the key number to watch is the so-called medical loss ratio. That is, United Health takes in lots and lots of premiums from its customers. The medical loss ratio is how much of those premiums go out the door in paying for stuff. 82.8% was the number in the fourth quarter. That was in line with analyst estimates. Now, United Health tends to be a consistent outperformer on this metric. But is it outperforming enough? In other words, just meeting estimates seems to be maybe one of the reasons why the stock is slipping here. What's interesting, though, is that United Health actually is down thus far in 2023. So it's interesting that even given that sort of underperformance, it's down about 6.5%, that it didn't do a little bit better in response to these numbers today.
Yeah, and over the past kind of 52 weeks, it's been an interesting story between United Health and even some of the outperformers that were in the broader healthcare or even biotech landscape during 2022. And just a larger question of, can that be repeated in 2023? I think for United Health over that period of time, they were up actually over the past 52 weeks by about 6%. So one of the few companies, and you kind of take out or strip out energy and then additionally some healthcare names that were actually able to see a positive move over the course of the past 52 weeks, as many companies across other sectors saw some extreme headwinds on their share price valuations.
Yeah, and a lot of the investors we've been speaking to, healthcare is one of the areas they like for this year. Healthcare tends to be defensive in a down economy. You got to get your medical care right. So that's one of the theses behind that move. So we'll continue to watch United Health. We got some more earnings we got to run through, but first we got to do the opening bell, which is coming up in just a moment. A lot of people watching the banks, which definitely are seeming to cast a pall over any gains we otherwise might be seeing this morning. All three major averages are in the red. We have been seeing a rebound in stocks here to start the year, so perhaps taking a pause on the back of that as well. So here we got the opening bell on this Friday morning. Remember, folks, Monday is a holiday, Martin Luther King Day, and the Memorial Foundation is ringing the opening bell this morning to mark that holiday, ahead of that holiday. Just getting back to what we're seeing in stocks for a moment, our friend Ryan Dietrich pointing out an interesting stat here this morning, chief market strategist over at the Carson Group. The S&P 500 is up now after 8 trading days, almost 4%, 3.74%. He said it's the best start to a year since 2003. So the pause that we are taking after a little bit of rally here to start the year, Brad. What are you seeing over there at the Interactive?
Yeah, well, talking about that year-to-date move that we're seeing thus far in the S&P 500, you're seeing things higher, as you were mentioning a moment ago. But here on the day out of the gate, we are lower by about 0.75%. We'll keep a close eye on that. The Nasdaq Composite tech-heavy average, you're seeing that lower by about 0.8%. But year-to-date, of course, different story there. So a little bit of buying activity re-entering into the fray here. It's up by about 4% year-to-date. And then the Dow Jones Industrial Average going into the holiday weekend, we're seeing that lower to start off the day by about 0.7%, but year to date, again, still in positive territory. So holding on to gains for the U.S. major averages here on the year to date scale thus far. It is early. We are in January, and that is a known, but let's also take a look at some of the unknowns, at least until right now. And that is where the 11 S&P 500 sectors are faring. We're actually negative across the board right now. Energy, you're seeing that as the best of the worst here on the day. Flat, just barely to the downside. But bringing up the caboose here, you've got financials down 1.3%. We were just running through some of the bank earnings, and then consumer discretionary. That's also down by about 1.2% out of the gate this morning. Julie?
Yeah, and speaking of the bank earnings,
Yeah.
we got the big ones that we talked about are not the only ones that reported. So let's talk about some of the other financials that we heard from. BlackRock is one of them. That company reported earnings for the fourth quarter that saw the asset manager beat on both the top and bottom lines. However, profits for the quarter were down 18% year over year, and revenue for the full year was down 8% as well. Also, we got to talk about assets under management when we talk about BlackRock, right? Net flows into some of their long-term investment funds were $146 billion, which is above what analysts had anticipated. Total net flows, so that includes outflows from the cash management accounts, $114 billion. So overall, BlackRock now manages $8.59 trillion. But if you look at there, it looks like it is it's up, down year over year, but up from the end of September. And CEO Larry Fink saying the current environment offers incredible opportunities for long-term investors. He did make a little bit more pessimistic comments about the broader economy on the company's conference call, guys.
Yeah, they also, and Sazi, I'll toss to you in a second, record full year net new sales of Aladdin. That's their kind of software management side. That's the portfolio management software that they did have there, and continued growth services. And it'll be interesting to see where they invest more into some of their software plays, especially as they had already noted as they classified it, the modification in the size and shape of their workforce, but we all know that to be translated into some of the headcount reductions that we've seen.
Well, I might want to pull back on some of those investments, Brad. I'm looking at their adjusted operating margins down about 540 basis points year over year, in large part because that drop in assets under management and maybe expenses not coming down fast enough relative to that drop in AUM, as they would say. So a red flag there as well. And speaking of tech expenses, another little note from JP Morgan, too. Jamie Dimon saying they're not pulling back on their tech investments. And that has been a big source of contention on the street. Is it JP Morgan spending too much for technology that will position them correctly, maybe correctly over the next decade? I guess you could put that same question out of BlackRock.
Yeah, well, JP Morgan also, as we talked about yesterday, bought a fintech that it said made up people. So there's that too. Just real quick, I mentioned Larry Fink had made some more pessimistic comments about the economy. He said specifically he fears the world is entering an area of economic malaise. So
That malaise,
yeah.
That'll certainly sneak up on folks and the markets. Well, let's also check in on Hanes Brands, that ticker symbol HBI. After upgrading its outlook for fourth quarter sales, the company also in search for a new CFO. They announced that Michael Dastuig has resigned from his role as Chief Financial Officer. That is effective February 28th. Resigning for family reasons is what they noted here. The company has initiated their search to fill that role, but he's going to continue to serve the company in that financial consultancy position through the second quarter of 2023. But at the end of the day, I think for some of the net sales that we were discussing a moment ago as well, they had noted, at least from the CEO, Steve Bratspies, who had said that we're pleased that they delivered fourth quarter net sales and adjusted operating profit above or in line with their outlook, given the dynamic macro environment. And they ended 2022 with inventory units below last year's level. That's important to note. So it is, as across some of the apparel manufacturing, inventory is still going to be a key barometer to kind of track, as many of them have said. And I think back to Nike's results that, yeah, we think that the worst of the inventory issues that kind of plagued us for a couple quarters, that the worst of us, or the peak of that inventory issue, is in the past. And so now for a company like Hanes Brands too, we'll see if that remains intact, Saz.
Yeah, Brad, I think you just summed up that tidy whities. They're resilient to the economic slowdown. I mean, you wear out of your underwear for one reason or another. You need to get new underwear. Even if it's $1 more, you have to replace the stuff. You're not going completely bare in a pair of jeans or leggings. So there's that. And then, I'm also thinking about the read-through to what it means to Walmart. You mentioned Steve Bradsby. He used to be the chief merchant at Walmart, so of course he knows Walmart very well. Walmart is the largest customer for Hanes brand, so if they are at least reaffirming guidance, maybe Walmart didn't do so bad in the fourth quarter. Of course, there are concerns about how some of the more discretionary areas of their business, again, looks to be they're selling a lot of white underwear.
I can, I'll refrain from commenting
Brad,
on
you reminded me
wearing
though
patterns.
that Michael Jordan used to show for Hanes. I had forgotten about that.
He was a huge spokesperson for Hanes, and then there have been a lot more of the kind of technical fabric plays out there too. Hanes has had to kind of pivot in order to remain kind of fashionable or in trend with that, whether it be a Tommy John or a Lululemon. A lot of the new technical fabric making its way into the undergarment size. So. We'll see. How
yeah, I know. I'm glad you were. That's great analysis. That is news we can use, Brad. Indeed, I appreciate that. Is next level analysis on the future of underwear.
Okay, all right. We gotta move on.
Do we have to though? Do we really have to though?
They said rap in our ears, so I think that's it. Coming up
several times.
Why our next guest is predicting choppy conditions for the equities in the coming months. We're going to discuss that next. RBC Capital Markets is anticipating a modest gain for the S&P 500 this year. The investment bank putting its year-end price target for the index at 4,100. For more on the analysis behind this call, let's go and get to the RBC head of U.S. equity strategy, Lori Calvasina. Lori, always a pleasure to speak with you. I believe this is our first time touching base in the new year, so Happy New Year to you.
I think so. Thanks for having me.
Absolutely. And so help us walk through this target, 4,100 by the end of the year. Is it a straight line there? Is it kind of a lot of choppiness to get to that point? What is it from your perspective?
I think it's a choppiness. I think it's going to feel like a rough year. I expect us to eke out a little bit of a gain, maybe kind of a flattish type year is how it's going to feel at the end of the day. Look, I do think there's a chance that we have some decent volatility in the first quarter, and I know we've had a good start to the year, but we're sort of watching the banks react to earnings today, and it's a good reminder that the onset of tougher earnings and the onset of a tougher economy is something I think markets are going to have some trouble digesting. Now, I'm not as bearish as some of my peers in the strategy community. I'm not arguing for 3,000 on the S&P. I think this is more of a retest, if that, of the October lows. But I think we've got some wood to chop here.
What do you think is going to be supportive? Why do you think things aren't going to be worse and aren't going to, say, retest the lows or go even lower?
So I think it goes back to what kind of recession do you ultimately expect us to have, and how does that get reflected in markets? So the October low we had was about a 25% drawdown. A typical recession is 27. If you're going to get to even 3,200 on the S&P, that's pricing in more like a 32% decline. And remember, the pandemic was just 34. So we think it's going to be that bad. I'm still not convinced of that. The other thing is we think earnings expectations, they are a headwind now, but markets, if you look at S&P pricing, typically find a bottom 3 to 6 months before earnings forecasts stop falling. Now, when do we think earnings forecasts are going to stop falling? Most years, we do tend to see that the cuts are done by April for the most part. So if you can kind of get most of the cuts done by March or April, timing-wise, that October low makes sense.
Lori, within the sectors that you track from a company perspective, we had a JP Morgan calling out today. They're playing their business on a potential mild recession. Are there sectors that you see earnings estimates have already factored in a mild recession?
So I think that if you look at an area like semiconductors, we've seen the rate of upward revisions basically late last year plummeted to almost zero. And what we typically see there is when you're that low, most of the cuts are in, and it's a good setup on a 12-month forward basis. I can contrast that with something like software where we haven't seen the same degree of cuts. So I worry a little bit more about software and services companies than semiconductor companies, just in this reporting season, because I think one of them you probably had most of the cuts in, and the other I feel like there's still, from a sentiment perspective at least, some earnings downgrades that need to happen. The other area I worry about, we're going through financials right now. It's a sector we like this year, but it's been more resilient in terms of earnings expectations. So do some of these leaders, some of these areas of resiliency like energy and financials, utilities, real estate, do they need to take their licks before we can get this downgrade cycle out of the way?
Right, because maybe the estimates haven't come down enough. One area that you have consistently liked for a while now has been small caps.
Yes.
We've been talking about it for a little while. I was just taking a look at the Russell 2000, which is down 13% or so over the past 52 weeks. Not as big a drop as the S&P 500. Are we going to start to, there's not a big gap though in between the two. Are we going to start to see that gap grow?
I think so. And I was actually looking this morning at the year-to-date stats on the S&P versus the Russell 2000, and small caps are stealthily outperforming. I think we're up like 5-6% on the Russell, and not quite as much on the S&P, closer to like 2-3%. So you're starting to see, like, every little day that the small caps do a little bit better, it's adding up. And the small caps, they made their low in June, didn't make a new low in October, really have been outperforming since mid-May, with giving some of it back in December, but very quietly they're emerging as this pocket of resilience. And I think it's pretty clear that if you look at how they were trading over the summer versus large, they were baking in ISM manufacturing that had already plunged to like 39. So small caps just got this recession trade out of the way very, very early, and we've had this sloppy catch down in large cap that may not be completely done playing out yet.
Lori Calvasina, RBC Capital Markets Head of U.S. Equity Strategy. Have a great weekend. Talk to you soon. All right, coming up, a bullish profit outlook for Delta for this year and 2024, but the stock is under pressure. We'll dive more into that quarter-end outlook straight ahead.
Delta earnings flew above expectations for the fourth quarter, but the airline trimmed its guidance, citing profitability headwinds, and that's to come due to a new labor deal with its pilots union. Citigroup analyst Stephen Trent joins us now. And let's break this down a little bit further, because it's really kind of that comparison that we've continued to look back to versus 2019, and this being lighter than that, at least for the estimates for the first quarter here. But I want to get kind of broad strokes, your takeaway from the quarter.
Yes, good morning, and thank you very much for having me. So I thought the quarter itself was quite fine. They beat consensus, and I think that's consistent with some of the data we've been seeing in the space. You know, with respect to the first quarter reaction, I'm a little surprised that the market's taking it this negatively. So yes, you do have the potential that the pilot's contract is starting to kick in here. But in the very first page of the earnings release, Delta mentions over $500 million in profit sharing for next month. And it's likely that the street hadn't anticipated that. Now, the other thing, of course, I think bigger picture, when you look at 2023, the guidance didn't change one iota. So is there going to be some modest lumpiness quarter to quarter? There always is in this industry. But we were quite encouraged to see the full year guide intact.
Stephen, that we mentioned earlier in the show, Delta's still looking for $7 per share in earnings for 2024. Is that too optimistic of an outlook given the longer term outlook for jet fuel prices and life after the pandemic?
Yeah, I think that's a reasonable outlook. So we still have counter-cyclical trends that are supporting ticket demand. So the way that people are traveling now, the balance of capacity that's in the market now, less regional, more premium cabin, and the weighted average fares are still up considerably year over 3 year, or excuse me, now it's year over 4 year. And when we also look at mix, you actually have loyalty program, co-branded card revenue really spooling up here. So, you know, I don't think that's too optimistic at all. You know, jet fuel, that's a little harder to say, but certainly, you know, the crude oil curve remains in backwardation. And I think we should see over the coming quarters that SETMA cost tailwind coming through. And that should provide support this year and next year. So, you know, once again, I was encouraged to see no iota of change in 2023 or 2024's guidance adjustments.
Stephen, Delta's typically regarded as sort of best in class here among the airlines. If we have results that on the face of it look fairly solid and you see this kind of negative reaction, what does that tell us about the rest of the airlines when they report?
Yeah, certainly. So, you know, one thing that the group is going through at the moment is they're trying to cut agreements with their pilots. So remember, when Delta put out the 2023 and 2024 guidance, that was actually after they'd reached a tentative agreement with their pilots. One could assume that the guide for this year and next is at least partially baked in the cake, but not everybody's there. So you've had some of the airlines reach tentative agreements, and others are still trying to work that out. So, you know, not everyone has the robust profit sharing structure that Delta has, and I would imagine that their employees appreciate that profit sharing policy that they have. But we could see some lumpiness from some of the others on a short-term basis as the group's still trying to cut agreements with their pilots for the most part.
Well, we'll see what ends up happening with those pilot agreements and what it does do to costs indeed. Citigroup analyst Stephen Trent, thanks so much for joining us to break this down this morning.
A pleasure. Thanks for having me on.
Take care. Coming up, Disney CEO Bob Iger is sailing past his meeting with activist investor Nelson Peltz. Maybe literally. Sazi has his take next. Disney had some drama this week. The company opposed activist investor Nelson Peltz's attempt to join its board. And in the latest development, CEO Bob Iger reportedly was vacationing on a yacht during the holidays and put off a meeting between himself and Peltz because he planned to, quote, sail off the coast of New Zealand. The life of luxury is where we find Saz's take. And this is, Peltz called him out for this, right, Saz?
It's good old sleuth reporting there, Julie. It's actually a personal passion of mine to read these activist proxy filings when they occur, because this was a really fascinating read, trying to file this proxy against Disney yesterday. And just it goes through all the accounts of the interactions between Peltz, the general counsel at Disney, Bob Iger, and other executives at the company. It's just really fascinating. And one thing that stood out to me, December 20th, there was a call, and Peltz wanted a meeting with Iger and the board, but Iger informed him that he couldn't do it then because he was getting ready to sail his yacht around New Zealand. So interesting to see that with the stock price under pressure. No dividend for the retail investors that have long held or loved Disney. So still no dividend there. They cut that during the pandemic. And now under attack from an active investor, you had a returning CEO, Bob Iger, going to chill on his yacht around the holidays. I ultimately don't think it's a very good look, even for a top executive for Bob Iger. Nonetheless, that meeting, they did end up holding between the board members, Iger and Peltz, later on in January. A source tells me there were no questions from Disney board members to Peltz on that virtual meeting, so which is very interesting to hear that. You would think, given Peltz's strong track record, you would get a more engaged Disney board here. But the source tells me that Nelson's gearing up for a fight, and I just think this has all the makings, big egos, big money, and maybe even a big yacht in the case of Bob Iger, all the makings of a long, protracted or just a really ugly activist campaign, not unlike the early days and when Peltz attacked P&G a couple years ago. Again, you had a lot of big egos, a lot of big money, very storied brand, in a company that didn't necessarily want change or didn't want to take Peltz seriously. But Peltz's track record has been phenomenal for as long as I've covered him. So I think Disney would be wise to at least bring him into that boardroom and listen to what he had to say.
All right. We can't help but imagine that, Iger's text might have been something like, I'm on a boat, can't take the meeting right now. But like you said, not a good look, as we were seeing there in the take a moment ago. Peltz has also been busy, though, with Wendy's, right, Saz?
Yeah, busy week here for Nelson Peltz, Brad. So this news hitting this morning. Late last year, Peltz explored a acquisition of Wendy's. Of course, he has been a longtime investor in the company, also the longtime chairman of Wendy's. He said today that he will not be taking Wendy's. He's not interested in doing a deal for Wendy's. That off the table. But when Wendy's is coming out here with a dividend raise and a promise to cut back on expenses. Now, Wendy's has pushed very aggressively into the breakfast day part. So maybe they could bring some of those expenses down now that launch is pretty much done with. But again, Peltz will not be buying Wendy's.
All right. Saz's take here on the day, plus some extended tracking on Peltz. Appreciate it, Saz. Guys, coming up, we're going to get some breaking news on how consumers are viewing the economy. That's next. Well, welcome back on this Friday morning. I'm Brad Smith alongside Julie Hyman and Brian Sazi, who you see there on the screen. Markets this morning, we've been continuing to keep a close eye on the U.S. major averages as we're lower across the board here. That combined with some economic data that's just come out at 10 a.m. There you're taking a look at the U.S. major averages, down right now fractionally for the Dow, the S&P 500, and the Nasdaq. But to the breaking news, Julie.
Yeah, the economic news is actually good. 64.6, the reading on University of Michigan consumer confidence. This is the first reading we get for January, the preliminary reading for January, and it is better than estimated and an increase over the prior month. Current conditions at 68.6, much better than estimated, but even expectations are better than estimated at 62. So really interesting here. The projection for inflation a year from now is also coming down a little bit to 4% from 4.4% in the prior read. So again, interesting here, a more positive read from consumer inflation, and is in line with some of the strategists and economists we've talked to who said the consumer is actually okay for the moment. It's a question of what happens next.
Yeah, certainly. With regard to this reading, the current reading is the lowest since April of 2021. But the Survey of Consumers Director Joanne Shu also points out that this remains well above the 2.3 to 3% range that they've seen within the 2 years prior to the pandemic. So that's some of the context on this. But the long run inflation expectations, they were little changed from December. And so all of this considered, uncertainty both over inflation expectations and those measures remains high. They're pointing out as well, changes in global factors in the months ahead may generate a reversal in some of those recent improvements they're noting here too.
Yeah, one line that stuck to me here, guys, quickly, is just the current assessments of personal finances, up 16%, really the highest reading in 8 months. Very interesting considering, and I know the survey pointed to easing inflation, but we're talking all week long about egg price inflation, rent price inflation, healthcare price inflation. So to see that increase was very interesting, especially stacked alongside what looks to be a disappointing holiday shopping season for a lot of retailers.
Yeah, but at the same time, a lot of measures of inflation have eased. A lot of components of inflation have eased, even as egg prices have gone up. Some of the other protein prices have mitigated. And as we know, headline inflation was down 0.1% month over month. So if people are watching like grocery prices, maybe that's besides eggs, looks a little bit better.
Or maybe they're just not eating eggs.
Maybe they're just not eating eggs. There's also, it also says in here, it's also on the basis of higher incomes. So that is a factor as well, Saw. So we're going to continue to watch these numbers. We also continue to watch what's going on with bank earnings this morning. Yahoo Finance's Alexander Semenova has been tracking all of the numbers here. What has stood out to you thus far?
Well, guys, just parsing through some of these results, listening to some of these earnings call, the general takeaway is that it was a really lackluster quarter for Wall Street's big banks, as we can see from the market reaction today. Of course, the big themes are that investment banking revenue was down substantially, net interest income was up, and net loss reserves were up. Of course, these big banks were setting aside more rainy day funds for potentially sour loans. Let's start with JP Morgan. It is, of course, the largest consumer bank in the U.S. by assets, so it's always a bellwether for how the economy is doing. And of course, CEO Jamie Dimon is the most animated of bank CEOs. That was a really interesting call. The things that stood out to me was that $2.3 billion that they set aside for loan loss provisions. That amount was actually much higher than some of its peers, higher than Citibank and Bank of America. They attributed it to more credit card usage, people, racking up those credit card debt, due to inflation. They also attributed to the fact that they now forecast a mild recession, so they put a lot of reserves aside for that. Still, though, CEO Jamie Dimon continued to say that the consumer is in good shape for now. Of course, people are eating away through those savings that they have allotted during the post-pandemic period. He did, however, point out a number of risks. The usual ones, as he highlighted in recent months, are continued worries about geopolitical tensions in Eastern Europe, the war in Ukraine, of course, quantitative tightening, what the Fed will do. So he warned about that. That's why the stock is down today.
Yeah, some of those warnings factoring into their modeling for a mild recession right now. What about Bank of America, Citi, Wells Fargo? What good nuggets were in there?
Yeah, so Citigroup's profit actually fell because of those higher loan loss provisions and because of the slowdown in deal making. However, it did have its best ever quarter for trading revenue. Citi CEO Jane Fraser actually said that markets had the best fourth quarter in recent memory. Wells Fargo said that it took a big hit on a $3.7 billion settlement with the CFPB to settle allegations that it harmed 16 million people with deposit accounts, auto loans, and mortgages. And then Bank of America posted a modest increase in profits. It really reaped the benefits of higher interest rates. The bank reported a boost in net interest income as well as higher trading revenue, specifically on fixed income. Bank of America has actually been expanding its fixed income business. And an interesting thing said on the call is the CFO said that they have no plans for any massive job cuts. That's, of course, different from what we're hearing from peers like Goldman Sachs, which is laying off more than 3,000 workers this week. And speaking of those job cuts, JP Morgan and Bank of America actually reported higher headcount. So really interesting to see that when we're hearing all this talk of Wall Street layoffs, they're actually still in hiring mode.
A busy morning for you, Alexandra Simonova. Thanks so much. Appreciate it.
Thanks, guys.
All right, the U.S. economy isn't in a recession just yet, as seen in today's big bank results. So is it time to get more bullish on the consumer and, by extension, retail stocks? Let's check in with Loop Capital Managing Director and friend of the show, Anthony Chikamba. Anthony, always great to get some time with you here. So you've done a lot of work on the consumer. What is the state of the consumer, and what does it mean for some of the retailers that you cover?
Sure. So, yes, we have a monthly report. We call it the Eye on the Consumer. It's just a bunch of different macroeconomic variables that we keep track of to kind of gauge where the consumer's head is at. And I will tell you, the last few months, we are getting more and more bullish on the consumer. First off, the employment market remains incredibly robust. The unemployment rate is 3.5%. Initial jobless claims are very low. Continuing jobless claims are very low. Wage growth is actually pretty decent. Now, the housing market is tough, but the main thing is that inflation continues to come down, right? So the latest rating was 6.5%. That was down 60 basis points, from the prior month, 130 basis points from 2 months prior. So the Fed's interest rate increases are clearly working. And in addition to that, gasoline prices continue to decline. They peaked at $5 a gallon last year. They're now down to in the low kind of $3 range. So, we're starting to think that we may see a risk on trade because it's looking to us like there's a higher probability that we have a soft landing in 2023.
Anthony, well, if the consumer is going to, hang tough at this year and maybe surprise a few folks, what does it mean for companies trying to turn themselves around like a Bed Bath & Beyond? Can they survive?
Well, Bed Bath & Beyond's a very, very unique situation. And, it's funny. I've been thinking a lot about Bed Bath & Beyond lately. And I will say what is going on with Bed Bath & Beyond just the past few days of what's gone on with their stock price, it is a living, breathing example of the need for financial literacy education in the United States. I mean, Bed Bath & Beyond is going to go bankrupt. You don't have to believe me. I mean, it's been very widely reported in the press that they are, working with Alex Partners. Now there's a report that they're working with Sycamore Partners on, a prepackaged sale of assets, probably Bye Bye Baby. And so the fact that the stock is up since they reported earnings is nonsensical in a word, quite frankly. I mean, when they file, the equity will be worthless.
A lot of retail traders out there are kind of asking about why media covers Bed Bath & Beyond the way they do. But I think at the end of the day, there's so many of the fundamentals from a business perspective, too, that we have to acknowledge and have to be acknowledged that go counter to what the stock price is actually doing, even if they omitted the word bankruptcy from their most recent earnings.
100%. I mean, look, believe your lying eyes. I mean, look, the fat lady is not just singing. She's on her encore right now. Bed Bath & Beyond is going to go bankrupt. And so the fact that the stock price is going up while a bankruptcy filing is imminent, I mean, that's a story. So this is not a, let's blame the media. There are no conspiracy theories here. This is a company that's going to go bankrupt, and the stock should trade accordingly.
Anthony, it's Julie here. I mean, it's also striking to me that in this environment, the company is doing that badly. I mean, you do outline in your report some of the challenges and headwinds, and you were just talking about them that retailers are facing. We did just get a consumer confidence read from University of Michigan that was better, right? So it's not like consumer spending is going to go to zero here. So there is opportunity for retailers. If you take Bed Bath & Beyond on the one hand, like, what's on the other polar end of that spectrum?
Well, look, I mean, to your point, I mean, there are very company-specific reasons that Bed Bath & Beyond is struggling as mightily as they are. Mistakes in strategy, trying to go to private label products. They got caught up in the whole, supply chain morass of last year. But that's very, very unique, to Bed Bath & Beyond. As I said, I mean, the fact that gas prices are coming down, the fact that consumer confidence, like you just said, is getting better, the fact that the labor market continues to be very, very robust. I mean, these are all very, very good things. But at the end of the day, the rising tide lifts all boats, but not if you have a big hole in your hull. I mean, you're going to sink.
Anthony, your analogies, I love them.
It's spot on. Anthony, while we have you as well, something that you were mentioning about being bullish on the consumer right now, I think back to what Matt Maley of Miller Tabak told us, and it was about demand, and him saying demand is fine because companies are lowering prices. We've just come out of a heavy promotional period in the holiday season. And his point at the end of it was, well, I guess demand's not fine because that shows that the consumer is really looking for some of those lowered prices. But is that a baseline that consumers can count on that feeds into the bullish sentiment that you may have on the consumer right now?
Look, I think that, last year, a lot of retailers raised prices because of inflation, right? I mean, if you have to pay your employees more, if you have to pay more to get goods into your stores, at some point you have to pass those along to consumers. I think that if we start to see supply chain costs come down, as we've seen, if we don't see the level of wage pressure, and particularly if retailers start to kind of blink and lower prices, then other retailers have to respond accordingly. I mean, price transparency is as high as it's ever been, largely because each of us has a smartphone, right? And so we can easily compare prices much more easily than, let's say 20 years ago when you'd have to kind of drive from store to store.
So what we've also heard from some manufacturers of apparel and footwear is that the inventory peak is behind them. Do you believe that to be true?
There's no question about that. And we've actually been doing some work on that. So, yeah, if you recall, and part of this had to do with the pandemic, right? And the fact that the ports were all, screwed up. And you had all these, ships that were, off these West Coast ports. And a lot of retailers, quite frankly, they were being more aggressive in terms of ordering inventory because they thought it was going to take it so long for the inventory to get to the stores, and also because demand was quite stronger. They got kind of caught with their pants down. I mean, Target and Walmart were probably the two poster children of that. But what they did is they very aggressively worked through those inventories. I mean, retail inventory is not like fine wine. It does not get better with age. And so I think what you're going to see coming out of holiday is that a lot of these retailers' inventory positions are going to be much, much better than they were in early 2022.
Loop Capital Managing Director Anthony Chukumba, always good to see you. Looking forward to continuing our conversation over on LinkedIn. Anthony, thanks so much. Have a great weekend. All right, ahead of the break, let's pull up shares of Paramount. Yeah, thanks so much. JP Morgan analyst Phil Cusick leaving his earnings estimates for Paramount intact into the company's earnings. Cusick is calling out strong downloads of streaming platform Paramount Plus. Says Cusick, domestically, we attribute these strong trends to uptake from the Walmart Plus soft bundle, CBS fall schedule, NFL football, as well as the launch of Top Gun Maverick. Internationally, Paramount Plus trends likely benefited from hard bundles with Sky in Italy, Germany, Switzerland, and Austria, as well as the hard bundle partnership with Canal Plus in France. All right, Apple CEO Tim Cook is getting a pay cut that he asked for. You don't hear that too often. Julie will have the details on that, plus more top headlines you need to know next.
Some other headlines we're watching right now. Apple CEO Tim Cook is getting a 40% pay cut, though his total compensation package for the year will still come in at around $49 million. The request came from Cook himself following a shareholder vote which saw approval for his compensation fall from 95% to 64%. His stock award target for 2023 has also been slashed, though his base salary of $3 million remains unchanged. The tech giant shareholders have faced pressure to cut back on executive pay from activist investors like ISS. Apple's shares slumped in 2022 as it battled rising rates and ongoing supply chain issues. All Elite Wrestling is reportedly interested in merging with the WWE. That's according to reports from CNBC. AEW is owned by the Khan family, whose other assets include the Jacksonville Jaguars and the Premier League's Fulham FC. It's been a turbulent period for the WWE. Controlling shareholder Vince McMahon returned as chairman of the board this week after leaving this summer amid sexual assault allegations. The former CEO is said to be preparing the group for potential sale. Reports swirled this week that Saudi Arabia's public pension fund was looking to buy the business, but there was no confirmation of that. And a big rare earth mineral discovery in Sweden. The nation's state-owned mining company, LKAB, says it has located around 1 million tons of rare earth oxides in the country's far north. That would make it the largest deposit of its kind on the continent. Rare earths are not mined in Europe at all, with the region relying on imports from China, which is still the world's biggest producer. Rare earths are used in everything from electric cars to flat screen TVs and iPhone saws. As you know, my favorite rare earth to say is molybdenum.
Cool. Sounds like a really rare find by the folks over there. Julie Hyman, thank you so much. All right, more drama in the crypto world. Crypto firms Genesis and Gemini are being charged by the SEC for allegedly selling unregulated securities. Let's bring in Yahoo Finance crypto reporter David Hollerith, who has the details on this. Big Dave, take it away.
Yeah, so Brian, the SEC is filing a litigated action that's requesting a monetary civil penalty plus disgorgement of ill-gotten gains. And this lawsuit's coming as the latest problem for Gemini and Genesis. And it's due to a business partnership they had offered Gemini customers, which is called the Gemini Earn program. So like bankrupt crypto lenders that we know, Celsius Network, Voyager Digital, and BlockFi, Gemini had an Earn program that offered retail investors high yields on their crypto deposits, as much as 7% when times were good. Now, unlike these other lenders, Gemini didn't do the lending itself. Instead, it outsourced it to Genesis through a master loan agreement. And this is unique because Genesis typically only accepted institutional size customers. And it ran contrary to what the SEC has previously done through actions. And what we know publicly, it fined BlockFi for doing the same thing last year. And then it also, in September 2021, also prevented Coinbase from doing a similar offering. So Genesis's lending business, the company that did the lending for Gemini customers, took massive losses over the summer. It paused its lending business shortly after the FTX collapse and laid off about 30% of its staff last week. Now, otherwise, the company's remained silent and has been seeking more time to try and find a way to hopefully, I think what they're saying is to fund their way out of this. I've spoken to a number of Genesis creditors, some of them being Gemini customers. Gemini has one of the largest creditors committee for Genesis right now. And they've said that the company Genesis owes approximately over $3 billion to creditors. And, as to why Genesis hasn't yet filed for bankruptcy, the best answer I've gotten from creditors is that if creditors want to do it, to force Genesis to do it, they would have to pay a certain amount of fees, and nobody has the money now. So this is all coming after Gemini's executives and DCG parent company of Genesis have been sort of boring over Twitter, sort of pointing the finger back and forth at whose problem this is now that Genesis's lending business is not allowing customers to withdraw funds.
And David, meanwhile, Crypto.com is the latest victim of job cuts. What do you have there for us?
Yeah, by head count, the retail-focused exchange is one of the largest in the space, and its CEO, Chris Marzalik, announced the 20% layoff around 1 a.m. on Friday. And he cited major growth in 2022 and specifically noted the collapse of FTX as significantly damaging trust in the industry, which has led to the decision to make cuts. Now, following Friday's cuts, Crypto.com employed coming with the cuts, Crypto.com employs roughly an estimate by our tally, 3,600 to 4,500 employees. And last year, the company announced a series of layoffs in June and another series between July and October. And a spokesperson for Crypto.com has not confirmed the company's current size. Again, those were our estimates. But it's also worth noting that, we're just 2 weeks into 2023, and we've seen, up to 2,600 layoffs in the crypto sector by our count. And notably, Binance, the industry's largest employer, still hasn't announced any cuts since the crypto bear market started. And in fact, yesterday, Binance's CEO CZ announced that the company was thinking of increasing its headcount by as much as 30% this year.
All right. Yahoo Finance's own David Holloway tracking all things crypto for us. David, appreciate it this morning. Thanks. Coming up after a rocky 2022 for stocks, our next guest is going to break down how to navigate market volatility. That's on the other side of this short break. Inflation in the U.S. slowed to a 6.5% increase in December, marking the sixth straight monthly deceleration since a mid-2020 peak. But what does that mean for investors as they navigate through volatility? Joining us to break it down now, we've got Matt Quinlan, portfolio manager for Franklin Equity Group, and also Franklin Rising Dividends Fund and Franklin Equity Income Fund manager. You wear a lot of hats, Matt. Help us break it down. How can people navigate through some of this volatility?
Great. Well, thank you for having me. We think a great way to protect yourself. We do see some challenging times out there with inflation easing, but still at very high levels. We do see some challenges out there with slowing growth, really from the lag effect of significant rate increases over the last 6 months or so. So we do think there's some delay in the impact that people will see. So impacting corporate profitability, and consumers are certainly seeing some stress. But we do think an area for opportunity remains dividend-paying stocks, in particularly high-quality companies with less debt, often benefiting from having large markets, really good, resilient business models, free cash flow generators, and companies that can reinvest in their business in times of like we're in today, a little tougher times. So we see some opportunities across sectors, but we do see some challenges for 2023.
Are those quality names harder to find right now?
I think there are still opportunities across sectors. So we see opportunities in places like energy. We see opportunities in healthcare, services, medical devices, even parts of the financial sector, the private equity firms, which have a lot of uncommitted capital, but capital that's been committed to them by their investors. So we see a lot of opportunities across sectors. We are not, we like to say, we're not investors in the market, but really in select opportunities for companies that we've identified as being high quality, having good management teams and businesses that we think can really hold up over time.
Matt, when you see a JP Morgan on the earnings release call out a potential mild recession and they're planning for one, does that make you quick in your boots, though, with some of these theses?
No, I think we're not macro strategists per se, but we are aware of the conditions that are out there. We are seeing slower growth. We are seeing, while corporate profitability has been good and consumers are in good shape, we are seeing some weakening trends. Those comments from JP Morgan are not surprising. So we are mindful of that. I think where our focus is really on the opportunities for our company, and really thinking about, what are the range of outcomes for businesses that we've identified as long-term winners. So we are seeing some slower growth, signs some stress within the consumers, shopping less frequently, trading down, those types of things. So not a surprise in terms of the commentary from the banks. Things are still holding up well. You're starting to see some layoffs, not big numbers, but certainly in the headlines. So all things that we're aware of, and we're certainly thinking about as we review companies in our portfolio and companies that we're considering for investment.
We appreciate the analysis. Matt Quinlan of Franklin Equity Group. Have a great weekend. We'll talk to you soon.
Thank you. Thanks for having me.
All right, coming up, Meme Mania is back. We'll discuss what to expect from retail traders this year on the other side of the break. Don't go anywhere. Meme stock mania is back, at least for this week. Let's dive into this more with financial YouTube host Matt Kors. Matt, good to see you here on this Friday morning. We've seen really some major spikes this week on the likes of notably Bed Bath & Beyond. Also seeing activity pick back up in AMC and GameStop. What do you think is driving this return of some of these meme stock faves?
I think right now what's going on is beyond exciting. High volatility. And what it is kind of what we've seen a little bit in early circa 2021, where a lot of the short interest is starting to pick up. The cost to borrow is starting to pick up. It's being tough to be a short. And a lot of people are diving into the trade. Now, one thing I want to quickly say about it is exactly that. I would view the opportunity right now with the soaring, I believe, over 200% gain in Bed Bath & Beyond this past week, almost 30% in AMC and GME. The craziness that we're seeing, especially in BBBY, is exactly that. It's an active trade. I wouldn't look at the current scenario as, oh, I'm going to invest in it and come back years later and hope that it's grown. So yes, I think it's fun. Maybe you would consider it to be a little bit degenerate, but it is exactly that, a fun, active, high volatility trade.
How long does a fun, active, high volatility trade that is a little bit degenerate have legs?
See, I get this question a lot and I absolutely love it. Fantastic question. The best way to do this, because so many times people are like, what's the price it could go to? Is it could go to X, Y to Z? In my own humble opinion, I think the absolute best thing you could do is just use a classic trend following methodology, whatever one is your favorite. As long as it's going up, stay in the trend and keep moving your trailing stop loss with you. And ideally, as soon as it moves a little bit, you would want to set your trailing stop loss to break even. So in the worst case scenario, you don't lose anything on the play. But the reason I don't want to say of how long, like really time box it, is we don't know how long the trend will last. So you want to be in the trade as long as the trend does favor your position.
I mean, I guess the problem is, if as it has happened with Bed Bath & Beyond, it falls 50% in a day, right? Like, so then it's hard to sort of get out in front of it. First of all, I'm curious, Matt, are you actually active in this trade, or is it sort of fun in theory for you? And so I guess I'll ask you that, and then I'll follow up with something else.
So I still have my position in AMC and GME, but right now I'm carrying nothing on Bed Bath & Beyond. I always like to say the adage of like, you don't want to be late to the party. It might be cool in real life, but definitely not in the stock market. And by the time I saw what was going on, it had already moved at that point almost 100%. So I was late and I'm watching it. It's kind of fun to see the fireworks of almost as if you're a casino, a lurker watching people with big bets, but I have no skin in the game on this particular movement.
Yeah, standing at the Bed Bath & Beyond table watching as it unfolds, Matt. We had a sell-side analyst on earlier who covers retail, not Bed Bath & Beyond specifically, but covers retail, and said what has happened in the stock is sort of emblematic of a lack of financial literacy in terms of people jumping in there. What do you make of that comment?
I understand where they're coming from, but I don't fully agree. I think that's a very classic fundamental breakdown of how do you do a fundamental analysis of a company. And of course, there is a time and place for that. But as we've discussed in previous, interviews here, is more of, I believe value is, yes, fundamental value, but now there's kind of a community value that really took the stage in the start of 2021. So I think that's really the delineation between, are we talking about a long-term investment where I would say, yes, let's do a full fundamental breakdown versus an active trade. I think that's a key thing to delineate on and see the difference of what's happening here.
Matt, since you do still have that position in GameStop, let me ask you this. Every time I post something on a GameStop, recently there have been layoffs at the company, results have not been up to snuff, the NFT business has not worked. I get shredded on social media. And One, why am I so hated by this community on everything I post on GameStop? And then two, what is your bullish thesis on the company?
All right. So to take the first part of it, I've been there myself. It does seem as if you're not always saying something that goes with the entire group and kind of that group thing, that if you post a different idea of like, maybe this isn't the best, or maybe we need to think about this differently, it is very easy to get shredded on social media, but that's what social media is. I guess sometimes you just have to take those hits. I don't think it's really good because maybe sometimes people have a counterpoint that should be thought of, discussed, and really, I guess, pondered, especially when your money is on the table. So I don't think that's necessarily a healthy thing. But the bullish thesis. It's kind of, all right, are we going to talk about fundamentals for that long-term investment, or are we going to talk about the absolute wildfire cultural movement that we saw in 2021, where still a lot of people are in it for this concept of like the David Goliath fighting the shorts? With me, my thesis on it is where it's at right now and squeezing to those levels that we saw previously. Those levels were clearly not fundamental levels. I don't necessarily know if someone would argue that looking at the fundamentals of the situation, but it's more of that collective group argument of, hey, okay, there's a lot of people in it. It's more of that, the social media craze of like the craziness that people will kind of attack people. Well, those are also the people continually buying and buying. So it's interesting now that finance has very realistically taken on this aspect of, yes, you have to consider fundamentals, technicals, and now also what is the world of social media showing, which another way to summarize that is the power of retail. It wasn't just really a flash in the pan. We're still experiencing it now in the start of 2023.
Is there a non kind of mimetic trade that catches your eye right now?
So if we're talking more of medium term of like what I'm seeing in 2023, what you had with your, I guess, former interview right here, I'm actually still really excited about what we're seeing in the world of energy. If we just look at what's going on with the administration, the Strategic Petroleum Reserve kind of going down, we know there's a floor essentially going to be set at 70. So I think oil right now trading around 79 a barrel. I'm looking for energy to still kind of cruise to the upside this year. And other than that, we're in a very tough, restrictive economic environment. So I'm looking at just those classic diamonds in the rough that I would love to buy on a discount and hold for as long as I can. So strong balance sheet companies such as Microsoft paying a dividend, Home Depot paying a dividend, great balance sheets. Looking at other clear winners such as Apple, Nvidia. In the long term, if those companies end up failing, I believe we have far bigger issues. So I would love to add those on discount.
Matt, are there any other big spikes that you see coming up? Are there any, you obviously are doing research, you're making some fundamental calls. There's still the world of a lot of chatter on Reddit and on other social media platforms. Do you see any commentary sort of marshaling around certain names that we're not talking about yet?
I think right now the main, like all the talk that I'm seeing is kind of the craziness of Bed Bath & Beyond. And then we're seeing a little bit of the similar cohort sympathy play in AMC and GME. There's a lot of discussion there. One that spiked a little bit recently in terms of a lot of retail interest was actually it was a security under MMAT. It was their MMTLP. It was trading for a bit in December, and then all of a sudden FINRA kind of cut it off, and like it was really confusing. So right now, people are very much following that story to figure out what happened, because people were in the company and now it's gone to a private company and they don't know what's going on with their preferred shares. So that was kind of interesting. In mid-December, people are still talking about it, but I think that's going to go the way of let's talk to the SEC or FINRA to figure out why things went the way they went.
Interesting. All right, Matt, always good to get your perspective and to go outside of the Wall Street bubble. Appreciate it. YouTube host Matt Kors, thank you.
Thank you.
Coming up, meme account liquidity is looking to expand its Wall Street recruitment. We'll speak with someone behind that partnership next. A longtime executive search firm Whitney Partners is teaming up with digital media startup Liquidity, leveraging its connection with younger generations to disrupt how junior investment professionals land jobs at Wall Street's top firms. Here to discuss is Bennett Jordan, the Whitney Partners managing director, who will oversee the new venture. Thank you so much for being here. So Liquidity, very popular for its memes on Wall Street, especially young Wall Street. But how do you connect memes with actually getting those people jobs? Talk to me about exactly how this venture is going to work.
Sure. Well, you have to think about the following, that Liquidity is created, right? It is full of Gen Z and millennials keeping an eye on this for the transparency that he's created among the community, within finance, right? He's a news outlet that many others are picking. He gets news before a lot of the other major news outlets because it's coming directly to him from the source, right off the desk, right? So among this trust that he's created, the things that they are most interested in is jobs, career development, training, and courses of that nature. So naturally, it's a great idea to bring the jobs and the recruiting to this platform. So I'll give you an example. For instance, if we were running a search, Liquidity's reach far exceeds anything that the entire search community in the country could attain within one day, right? So his reach is just so powerful. He has 2.5 million collective followers across all platforms. The ability to leverage digital media and bring the recruitment to that, it's so powerful.
So do the jobs then get posted on those platforms? Is that how you're doing it?
So that is exactly what we're going to do. We're going to create it, transparency, put it out there so the candidates are coming to us versus the other way around where you have all these firms with associates pounding the phones trying to get in touch with other, recruits and candidates, right? So we're just kind of flipping the script on that and leveraging the power of digital media to bring those jobs to them.
Bennett, we've been reporting a lot the past month on Wall Street layoffs, some sizable cutbacks, notably in investment banking. Is that starting to shake the confidence of these junior bankers on what their longer term outlook might be in this field?
I completely understand. So funny you should say that. I think, for us as recruiters, disruption like that oftentimes creates opportunity. So you'll always have other firms that are able to attract dislodged talent or unsettled talent in these downturns, right? So we follow where the opportunities are, and that's the entire idea.
And so for the business model for yourself, now what does that look like when you're connecting kind of the applicants with the range of jobs that may be on the table, even though, as Sazi was mentioning, there are a wave of the layoffs or headcount reductions and even hiring freezes that are still in place?
Sure. So, we will be putting content out there to attract, the candidates and then engaging them in a formalized recruiting process after leveraging social media to attract them.
Is it weird working with someone who's anonymous? The guy behind Lit, so-called Lit, right, is an anonymous person who runs this whole account. So what does that do in terms of the layers of this partnership versus a more traditional partnership would be like?
Sure. I think he's just protecting himself. He doesn't want, the attention. He doesn't want, TV slots. And, let's be serious. He's putting news out there that sometimes can be a little unsettling for these institutions, right? Because he's putting the transparency out there for the finance industry that it's been lacking. So he just, he doesn't want that attention, and I totally understand and respect him for it. I think there is a time and place in which he will let his identity be known, but we'll leave that up to him.
Okay, well, we already know more about him now than we do about Satoshi, because that could be anybody out there. So this person, who I perceived has formerly worked in finance as well, are they also looking across where there is demand for financial industry talent to also say, hey, there are tech companies out there that are looking for some former Wall Street people to now bring into their fold? How does that kind of dovetail across other industries where you could be listing some of those opportunities?
Yeah, that's a great question. I don't think that we're there quite yet. Naturally, there's a big intersection there with venture capital, and growth equity, private equity, all of these things that we're going to be touching as well. So perhaps down the road, we have had inbound saying that big pharma, tech, AI all needs this as well for recruiting. So it's not out of the world of possibilities.
Just out of curiosity, you also were on The Bachelorette. I mean, I'm sure people are watching and recognize you for that. Like, is there any time between that and your recruiting business? Do people come to you and say, oh, you were on The Bachelorette, now I trust you to find me a job? I mean, I say that sort of tongue in cheek, but seriously, has that gotten you any more traction in your business?
Well, I've been doing this, for 10 years, and I will tell you this, it has not really been an impediment. I'm sure that there's some people, who might hold that against me, stiff Wall Street types, and that's okay. 2020 was a wild year. I was tired of, creating banana bread and lasagna like everyone else, and sort of doing everything that you were doing at home. So it was time to, do something different, shake things up. Needless to say, I wasn't having a lot of new client development during that time of that summer, and so it was time to go, open some doors and put myself out there.
Why not? All right. Thanks so much, Bennett. Thanks for being here. Bennett Jordan, Whitney Partners Managing Director, and now Litany Partners, doing a new partnership with Liquidity. Coming up, Saz and I are heading to Davos next week. We'll give you a preview of what to expect.
In the Swiss Alps, at an altitude of 5,100 feet, Davos is the highest town in Europe. The World Economic Forum says it picked the Alpine hideaway, about 100 miles south of Zurich, because it was the ideal retreat to get away from all the trappings of daily reality. Another benefit, in 1971, when the meeting was started by German economics professor Klaus Schwab, the town of Davos had recently built a big conference center. It didn't hurt that CEOs and political leaders could also hobnob on the ski slopes. The World Economic Forum styles itself as an independent, nonprofit organization, but it's also big business. Davos is all about access, and in true capitalist form, the more you pay, the more access you get, with your status determined by the color of your badge. Journalists and activists get in for free, but for everyone else who wants to be part of the elite Davos club, fees range from the tens of thousands to hundreds of thousands of dollars. Companies like Salesforce and Meta spend hundreds of thousands more to set up buildings on the promenade, where leaders schmooze potential clients and the media, sometimes at lavish late-night parties. That schmooze is key, how paying participants get a return on their six-figure investments. Musician will.i.am, primatologist Jane Goodall, BlackRock CEO Larry Fink, Alphabet CFO Ruth Porat, ECB President Christine Lagarde. In theory, we could strike up a conversation in the line for coffee with any of these folks this year. Networking aside, WEF says the point of Davos is to embrace the principle of stakeholder capitalism, the idea that businesses should serve all stakeholders, that is, employees, customers, and the public as a whole, and not just shareholders. Davos comes under regular criticism, in part for the gulf between how its participants see themselves and that mission, and how the rest of the world, the other 99.99%, sees it and them. WEF touts the real change it says it is catalyzed, from increased global coordination on attacking air pollution to the pivotal 1992 speech by South African President F.W. de Klerk together with Nelson Mandela. It's unclear whether its more recent dramatic moments, like Greta Thunberg urging participants in 2020 to act urgently on climate change, yielded equally dramatic results. You can't escape the optics of billionaires flying in on their gas-guzzling private jets. JP Morgan Chase CEO Jamie Dimon reportedly called Davos a place where, quote, billionaires tell millionaires what the middle class feels.
And indeed, Saz and I will be there next week reporting to you about what the zeitgeist is like. And one of our big questions, Saz, is whether we are still going to see big presences, big expensive presences on the promenade with this sort of belt-tightening environment we've seen among big tech.
Well, you'll sure see them on Yahoo Finance, Julie, because our guest lineup is awesome. And, this is the coolest conference that I go to every single year. And I think really, I'm looking forward to breaking down all these things these powerful people tell us and getting it out there to the Yahoo Finance community to help them build their wealth. I mean, it's very exciting. I do get the sense it's going to be a little bit more toned down party-wise, just based on people I'm talking with, but still a big celebration of business, lots of big ideas floating around, lots to get to for us.
Yeah, absolutely. It's going to be fun to watch. I mean, I've already gotten a sneak preview of the lineup, so I'm on kind of that inside scoop of who you guys are going to be speaking with, and it's going to be exciting for our viewers to take a couple nuggets away from those discussions, too.
Yeah, and if you guys have any questions for people, please tweet at us, and we'll ask them your questions. There should be, it's always an interesting place with some controversy, usually. We'll see. Brad's going to stick around in the next hour, by the way, and join Rochelle Akufo for our What Just Happened special. This week's focus will be Tesla's stock crash, which should be very interesting to talk about. And speaking of crash, we're seeing a little bit less of one today. The Dow is now higher, the S&P and the Nasdaq still lower. Oh, actually, I stand corrected. The Nasdaq just turned into the green. Keep it right here.
More than a car, more than a business, more than one man. Since its public listing almost 12 years ago, Tesla has built one of the most recognizable brands on the planet. Few companies owe as much to one individual, even fewer are as entirely at their mercy. When shares topped out at just shy of $410 in November of 2021, he was still riding the crest of the wave. Now the mission is entirely different for Elon Musk. Stop the bleeding. Going from the Iron Man inspiring techno king to chief twit and a social media agitator to rival the best of them. Leveraging the electric vehicle maker's astronomical valuation to send the rest of us into orbit with SpaceX. And maybe even reading our minds. Tesla was at the heart of it all. For some, the original meme stock, pumped up by investor fervor, Musk aficionados, and green climate advocates the world over. Now it's the target of short sellers, activist investors, and angry owners worried they aren't getting a fair shake. Another key investor was also dumping the stock, Musk himself, the only person to ever lose $200 billion in a year. Tesla and its leader now facing a firefight, a distracted chief executive, a tricky relationship with regulators, the allure of celebrity status, add to that an aging fleet of cars, a host of competitors, and the lion's share of profits coming from the most uncertain of economies. Are investors in Tesla just spinning their wheels? Was the strategy only good when the stock went to the moon? Is the party over? We look at the future for one of the world's most groundbreaking companies. Welcome to What Just Happened, Yahoo Finance's deep dive into the story dominating the news agenda, why it matters for your investments, and how it could unfold in the coming days, weeks, and months. I'm Rochelle Akufa alongside Brad Smith, and this week we're talking all things Tesla. Now we'll cover everything from the stock slump, Musk, the man himself, and what happens to the myriad of businesses tied to the world's top EV maker. So Brad, first let's start with those shares.
Yeah, absolutely here. And taking a look at Tesla shares as we've continued to be tracking them, and we'll pull up a look on your screen too. Right now, on the day, we're down by about 2.9%. But if we think even more broad terms here, we've got to remember the slippage or the skidding, if you will, pun fully intended there, that's taken place over the course of 2022 and what that sets up into 2023. Now, a few factors played into that slippage over the course of 2022, and perhaps none more notable than the fact that you had Tesla's CEO and founder, Elon Musk, selling off as many shares as he did to finance his deal with Twitter. That combined with some of the production issues that we had seen and a global focus that really cast some cold water perhaps on the demand, even within one of its most noted regions that they wanted to grow out their business even more in China, as some of that sentiment among shoppers there shifted to more of the homegrown brands. So we'll see exactly what that looks like as we move on throughout 2023 and where that demand starts to reemerge. But taking a look at the stock chart over the past 2 years, net, we are lower by about 57% over that 2 year in aggregate. And here's some of the interesting moments to keep tabs on, because one of the double tops that we have seen formulate within Tesla, and actually we would have to go back even further, but within the spikes that we have seen over that course and period of time, it's important to remember that this is a stock, this is a ticker symbol that has been through stock splits, that has been through a major selling off of shares, as I was pointing to earlier, and then additionally trying to make sure that even on the regulatory front, all things that we're going to break down, that they continue to remain in good favor in all of the landscapes and regions that they operate in. Rochelle.
I mean, Tesla's story really is fascinating. So let's get into more of this, Brad. We know that Tesla shares have been on a wild ride, especially as you mentioned there, over 2022. You have to wonder what's the biggest issue here. Is it having a distracted CEO? Is it having so many legacy players now in this space really vying for the attention of other EV consumers who perhaps want a cheaper alternative or perhaps don't like what they're seeing tweeted out by Elon Musk? And then, of course, you have the fallout that continues from his tweets, even stemming back from that settlement with the SEC, but still getting himself into hot water in the middle of a trial that's supposed to start next week because, he doesn't like to be reined in, our Elon Musk. Those who love him say he's a genius, but even some of his most fervent investors are getting very frustrated right now.
And we can't go without giving a nod to the broader environment that we find ourselves in, that the equity markets certainly have been reactive to, and especially within tech, which is the absence of easy money policies. When you have a Fed that is tightening and was tightening as aggressively as they were within 2022 to combat inflation, that certainly has an outsized impact on tech, which really looks through exactly where some of that money and the money supply can help them with their own investments. And I think for Tesla, that's something that investors also had to take note of alongside some of the other FANG-MANT names, if you will, a term that came about or an acronym that came about early on in 2022 as we continued to discuss and see exactly where that revision of some of the high growth internet names had really started to point to. And Tesla was one of those names that was thrown into that FANG-MANT conversation. So perhaps we need a new splashy acronym to really point towards in 2023 when we think about that as well, Rochelle.
I believe Ray Wan came up with Matana that covered the whole range of what he saw as some of these emerging stocks. But even with this frustration with Musk, we are still seeing a lot of people perhaps not bullish on Musk himself, but still bullish on Tesla at least. We saw that on Wednesday, a tweet from Tesla's third largest individual in shareholder, Leo Kogwan. He added about 50,000 more shares, he said. So he bought about 600,000 more shares in 1 week. An additional 2 million shares are being assigned this month. Now, this is someone, he really does love Musk. He's a self-proclaimed Musk fanboy, getting a bit frustrated, but still sticking with the company, still being bullish, despite some of the frustrations here.
Well, no shortage of content to discuss with our panel, from expansion plans to price cuts and, of course, the group's valuation itself. Let's get to Craig Irwin, Roth Capital Partners Senior Research Analyst, along with Dan Ives, Wedbush Managing Director and Senior Equity Analyst. Dan, I'm going to start with you because you're sitting to my left here in studio with me. When you think about what Tesla has been through last year and even more long-term perhaps, what does that set up for 2023 now too?
It's a fork in the road because on one hand, you have what I view as the most transformational company potentially, in the market along with Apple. But ultimately, in terms of what we saw with Musk and the Twitter situation, that's been a huge overhang in the stock. But then you look at the opportunity. I mean, we're talking 4 or 5 trillion of potential market opportunity over the next 10, 15 years. That is, it's still Tesla's world and everyone else paying rent in terms of EV. But competitions come from all angles. And in this risk-off market, you've seen cracks. After the Cinderella story, that's why they're cutting prices, demand's changing. And that's why for Musk, it's time to navigate the plane through the storm and not have a Ted Stryker moment.
And Craig, I know that you're more bearish on Tesla. What are you honing in on when you look at the outlook for Tesla?
So I've seen Tesla as egregiously overvalued over the last couple of years, valued at a multiple of the rest of the automotive sector combined. And there's nothing that they have that, names like Toyota or Daimler or others don't have themselves. So when I look over the next couple of years, I look at a decelerating growth for Tesla. Obviously, they're looking to counteract that by cutting prices, and they'll take it on the margin, while other people are really just seeing their new products take off and supplementing the product portfolio with exciting new brands and pretty compelling products that are finding their way into consumers' hands. So, Tesla's got real competition. They deserve a lot of credit for creating the market, but on a relative valuation basis, there's much better places to put money, and that's a difficult thing for valuation at Tesla.
Craig, I want to stay with you there and just follow up on the decelerating growth that you mentioned. Do you believe that causes a rift within the market share that Tesla holds on to?
Well, Tesla's market share is obviously going to fall. There's no question it's going to fall. The question is how fast, how soon. It's different markets are going to move at different rates, and they're fighting it. When you come out with a 20% price cut in one day on one of your mainline vehicles for North American markets, that is a big deal. That means there are big problems to solve, and Musk is looking to rectify the situation. This loss of whatever it was, $200 billion in wealth is pretty shocking. And, he's obviously looking to stabilize that, but he has, a massive boat anchor to deal with Twitter. I mean, he really probably does feel like an absolute twit. to use diction that he would know for his purchase, given that it's the distraction from Twitter that's really brought in the valuation, both at Tesla and the confidence in Elon Musk overall.
Now, Dan, I know you have an outperform rating on Tesla. Your 12-month price target, $175. What is Musk and Tesla itself going to have to do? Are some of these price cuts that we've seen, not just in China, but now in the US and Europe as well, is that going to be enough to get them there?
Look, I think Craig, who I have high respect for, I think he hits on great points in terms of what has happened over the last year. And I also think about 70% of the sell-off was Musk Twitter circus show driven. But now, really, the story changes. You have the price cuts. China, that's the hearts and the lungs of core Tesla. What does demand look like? Can they gain incremental share? What does the global scale look like? Now you could be at 2.2, 2.3 million units. What does ultimately these price cuts do to demand? And we believe could potentially spur units 12, 15%. So that's why after what's really been a Cinderella ride, and it's the best way you could put it the last 4 or 5 years. Remember, despite the haters continuing to hate, this is a stock that's been historic. But no doubt, now there's no more glass slipper. You're starting to see cracks, and you need to see, with competition increasing across the board, GM, Ford, others, significant competition. But I don't view it as a zero-sum game. I think this is what I view as the best and maybe the biggest transformation to the auto industry since the 1950s.
Dan, staying with you for a hot second, you said 70% of the sell-off is Twitter-driven. And so what percent of that would you kind of apply towards what we saw more broadly within the Fed's policy pathway? And once we have a pivot or some type of pause or at least change in tenor from the Fed and the market latches onto that, then what does that mean for Tesla shares?
Yeah, well, first of all, for risk assets, as we all know, 2022 was a horror show. Friday the 13th, just an absolute disaster because of what you saw in multiple selling off, risk assets basically heading for the elevator. Tesla, that's really poster child. If you think about it from a multiple perspective, as Craig talks about, it's the divisive. Do you treat it as an automotive company? We view it as disruptive technology. That's how we value it, but that's why it's an emotional bull-bear story. I believe you start to now see risk assets, tech, Tesla, you start to ultimately see these names really rally. And I think today's a good example. A lot of bad news baked in. You have 20% price cuts, Armageddon, stocks down 2%.
And Craig, we know that to try and meet demand, Tesla expanding its gigafactories in the US, also plans for factories in Mexico and Indonesia as well. But obviously, though, the business model, very capital intensive. What kind of position is Tesla in at the moment to really get the liquidity it needs to really make it a success?
Well, Tesla's clearly in a defensive position. They're trying to defend the stock. They're trying to defend growth rate. They're trying to defend market share, with models that are really long in the tooth. So, expect Elon Musk to remain defensive. I would agree with several of the things that Dan said. I've been bearish for a couple of years now on Tesla, saying that it was egregiously overvalued, and that, dancing actors in robot suits and, claims about, flying taxis or, that's my exaggeration, but, robo taxis are just hyperbole. And that's what was in the valuation at the top. And we're coming into a much more realistic valuation as people assess the relative opportunity for Tesla versus others. It's still the best name in the space as far as market share, their pioneer status, having done all the work, all the missionary work to develop the market. So they clearly have, the most experience and the largest fleet. But others are benefiting from that, and others will have a much more cost-effective ride. And that means there's probably much better investment opportunities in the next couple of years as we see the space continue to evolve and continue to expand. And we just think that people are probably better off not buying Tesla, looking at some of these other names.
Certainly some cheaper options out there, but Tesla clearly not going anywhere anytime soon. A big thank you to our guests, Craig Owen, Roth Capital Partners Senior Research Analyst, along with Dan Ives, Wedbush Managing Director, Senior Equity Analyst. Thank you to both of you. Now let's get to Dan Howley, who's going to tell you what's next.
Coming up, the last year was dominated by Elon Musk's will he, won't he quest to buy Twitter, a move that was made largely possible by leveraging the company's value. So how much of a distraction is the move, and where does he go from here? We'll take a look next. No discussion of Tesla is complete without talking about Elon Musk's decision to buy Twitter. The CEO's tumultuous path to owning the social network coincides directly with Tesla's share prices. So where do we go from here and how did we get here? Let's take a look. Everything started around January when Elon Musk started amassing shares of Twitter. We didn't find out about that, though, until April 4th, when he disclosed that he had purchased a 9% stake in the company. On April 5th, he then was offered a board seat by Twitter. He later rejected that, though, saying that he didn't agree with the moves that Twitter wanted to make at all. So on July 8th, he went ahead and, on April 25th, he said that he was going to buy the company for $44 billion at $54.20 a share. But on July 8th, he said that he didn't like the terms of the deal. He essentially claimed that Twitter wasn't providing him with enough information about bots, something he said he wanted to clean up on the platform, and that they weren't giving him the data that he had been requesting over and over again. So we filed to try to do away with the deal entirely. On July 12th, though, Twitter struck back. They sued to try to force him to purchase the company. He said that the company didn't offer him exactly what he wanted. They said that they had. While all this is going on, by the way, Twitter's former security head came forward to say that the company had awful cybersecurity practices and actually sat before Congress to discuss this. The lead up to the trial between Elon Musk and Twitter, though, also resulted in a number of text messages coming out between Musk and power players in Silicon Valley, going over how he would potentially change practices at Twitter, who he would allow on, the kind of discussions that he would allow there, how he would potentially monetize the platform, so on and so forth. And just as they were about to go to trial, Elon Musk on October 3rd came forward and said that he would finally agree to purchase the platform for $54.20 a share at $44 billion. Later in October, the agreement was finalized, and now he is the owner of one of the most influential social media networks around.
Roller coaster it took to get here. Where is Twitter at now?
It really is in almost this strange state of operating, but, at minimum capacity. He obviously laid off roughly half of the company. Then he laid off even more staffers. He had to hire some of them back. There's offices that are shutting down because they're not paying rent. This is an issue that goes beyond just the employees. I mean, the New York Times did a piece basically pointing out that there aren't enough janitorial staff at some of these locations. And so some people are being forced to bring in their own toilet paper. There's rooms that smell like bathrooms or rotting food. There's server issues. There was a potential problem that we had seen where Twitter was running slowly. A server that Elon Musk had ordered be shut down could have helped prevent that kind of slowdown. And then we're still talking about who's allowed back on the platform and who's not. You'll remember that Elon Musk, who previously was relatively close with Kanye West, allowed him back on the platform, and then he immediately kind of shot himself in the foot talking about anti-Semitism. He also brought back the controversial right-wing influencer Andrew Tate, who immediately got owned by Greta Thunberg. But this is something that I think we're going to continue to have to kind of parse, whether or not Elon Musk is putting enough time into Twitter, whether or not he's putting enough time into Tesla, how he can do all of this with SpaceX in between. But, the Twitter problem is this is an entirely different endeavor than what he's done previously. This is a social network. So this is not being able to buy sell cars or put together spaceships. I think that, when it comes to Twitter, he still has a lot of his work cut out for him.
Hey, thanks, Dan. Thanks a lot, man. So, next then, what just happened? Tesla's been around for a long time, but it's no longer the only game in town. Now you got serious competitors coming after them. We break it down for what it means to Tesla after the break. Welcome back to What Just Happened. I'm Pras Subramanian. Elon Musk is part and parcel of the Tesla story, taking the company to extraordinary heights, but now distractions with Twitter, demand concerns in China, and strong competitors are sneaking up on the company that once had the run of the place. Let's take a look at some of Tesla's main challengers. GM, the sleeping giant in the EV world, took its time developing a strategy centered on its Ultium battery platform. We're now going to see 3 EVs come out this year alone, joining the Chevy Bolt, Hummer EV, and Cadillac Lyriq. GM wants to build 1 million EVs annually by 2025. Then there's Ford, the company already selling thousands of Mustang Mach-E's and Ford Lightning pickups right now. CEO Jim Farley splitting up the company into an EV business and a legacy gas power division to focus on the future. Ford says it aims to build 2 million EVs by 2026 when new factories come online. Then there's VW, the German giant leaning in hard with his ID sub-brand of cars, revealing the ID.7 just last week at CES. Volkswagen intends to have 25 new EVs in the market by 2025, and some of those models will be made right here in the US, meaning they'll qualify for those all-important federal tax cuts.
Now, in addition to competition, there's the issue of Elon Musk's empty promises in the past. So can he deliver on those, Pras?
You know, Brad, there's been a lot of vehicles here and kind of brought up in the past, like Cybertruck, right? Cybertruck was debuted in 2019, was supposed to come out in 2021. But we will likely probably see it this year. We'll see. The Tesla Roadster, right? This is this $200,000 supercar that came out, again, debuted in 2019. We haven't heard much about when it's going to come out. And it's probably not going to come out for a while. And they've already taken huge deposits on that car. And finally, the Gen 3 Robotaxi, the cheap Tesla, the $25,000 Tesla that Elon Musk has talked about, brought it up in 2020, said last year, actually, we're not going to make it. And now we're hearing that we're going to actually see a potential platform or what it might look like at their investor day on March 1st. Again, if we see that, who knows when it'll actually come out in the future.
Now, Pras, let's talk Tesla's car designs. Unpopular opinion, I quite like the look of the Cybertruck. But while the overall designs are attractive for the other models, they are long due for a refresh, aren't they?
Yeah, you know, just looking at the models right now, they're all kind of long in the tooth. The Model S came out 10 years ago. Usually, automakers every 3 to 4 years will have a refresh and then a full redesign in 7 years, right? So the Model S came out 10 years ago. We saw a refresh of it last year. And the Model X SUV, they came out 7 years ago. Again, a refresh last year. And the Model 3, it's been out for about 6 years or so. And we were hearing reports that they might actually update some like interior components, not a full refresh or a minor refresh. So, you know, these models are kind of still a little bit older. People are still buying them, but at a certain point, when new cars come out, you might want to take a look at those.
Now, Pras, I'm old enough to remember when you scooped me from outside of our office in one of those luxury competitors out there, in that Mercedes one, but there are plenty other luxury competitors that are popping about. What do we know about those luxury competitors that are really entering into the fray?
You know, Brad, that's funny. That was a fun day we had with that EQS. But you know, Tesla doesn't break out their U.S. sales, but Automotive News has new data that shows they actually passed BMW this year as the top luxury brand in the U.S. overall, not just EV. So you know, Tesla's in a good, enviable spot there. But like you said, Mercedes with those EQS models. Brad, I actually have the EQB SUV, that small SUV. I'm picking it up later today to test that car. So that's a small EV SUV. So Mercedes coming on strong. BMW with the i4 and iX. Audi with its e-trons, right? So there's a lot of competitors coming on space in the luxury EV space. And Tesla, like we said before, it used to have the kind of the run of the road by itself. Now it's kind of being joined by a lot of new cars on the road itself.
And since this field is so crowded now, I mean, will people still be buying Teslas?
You know, Rachel, I have to say that is a yes, because we've been just talking about earlier today about those big price cuts that are going to make these Model 3s and Model Ys come under that price cap for the IRA tax credit. That's a huge kind of demand sort of push for them. You're going to see that happening just this quarter. But I think the biggest factor here, Rochelle, is the charging network. The Tesla supercharging network is still the best in the country, maybe even in the world. And I've been seeing a lot of reports, people very upset with EVgo, Electrify America, all these other charge networks, things broken, not enough chargers. You see plenty of superchargers everywhere that you go, and they're usually empty, and they're pretty fast. So I think that's a huge factor here, pricing, and then also that charger network.
All right, great stuff. Pras Subramanian there reporting for us. All right, coming up on What Just Happened, economist Paul Krugman talks Tesla's traction with fans. Here's a sneak peek.
Even if Musk had been everything that his fans imagined him to be, 15 years from now, Tesla was unlikely to dominate, but it gotta hurt now.
Welcome back to What Just Happened. I'm Rochelle Akufo alongside Brad Smith. Now, a recent New York Times op-ed from Paul Krugman has taken aim at Elon Musk over increasingly shifting the perception of the Tesla brand from a plaything of the rich and woke to an emblem of Silicon Valley excess and Elon Musk's shift to the right. I discussed the impact of Musk on his brands with the Nobel laureate and New York Times columnist. Take a listen.
Yeah, and this is not a judgment on the quality of Teslas or on the quality of Elon Musk as a manager. Leave that. I'm not a car guy, and I'm not going to try and give you my own opinions on the cars themselves. But the point is that this is an auto company. It's an electric vehicle company, but it's not the kind of company where you can expect an early mover, which Tesla has clearly been, to establish a sort of unchallengeable monopoly position. Tesla is not going to be Microsoft, even if everything goes the way it should. It's not going to be Apple. This is not a network externalities, as the economics jargon, where basically people use something because everybody else is using it, and it's very hard to break out of it. And so you get decades of extremely high profits. The car industry is not like that. And this is fundamentally the car industry.
And I mean, this is an increasingly crowded market, the EV space. And on top of that, I mean, a lot of people don't want to spend this kind of money. So we're not sure what that means for Musk at the end of the day. But you brought up Microsoft and Apple. And anytime there's some sort of tech great, there's always going to be those comparisons to a Steve Jobs. But obviously, Steve Jobs had laser focus and a lot of discipline. So when you look at Elon Musk and the sort of culture that he's bringing into the company, what do you make of those comparisons?
Yeah, no, again, I have no inside information on how much Musk's, other interests are affecting the management of the company, though it's not a good sign. But yes, Jobs had a vision. And also, let me say that at least at a certain point, it mattered that Steve Jobs was perceived as a really cool guy, as somebody who, there was a certain, the guy in the black turtleneck and jeans with the amazing device in his hand, that was something that people wanted to buy into, which helped to establish a position. Now you have Musk, who for a while had something like the same image. He takes us to outer space. He's and does interesting things, but he's now hurt that image, and that's again, I don't think, and crucially, I don't think even if Musk had been as disciplined as Steve Jobs was, that Tesla was ever going to be a sustained profit machine the way that Apple has been. It's just that it's not his fault. It's just not that kind of industry. But then I don't know anyone who's done as much to hurt his image of cool in as short a time as Musk has done.
And it does raise that existential question. What does it actually mean to be a Tesla owner now versus when it first started? You had a lot of, Democrats following along. You had a lot of sort of liberal elite following along. And then as Musk got more political, as he sort of was more right-leaning, became more vocal on Twitter, that narrative seemed to change. What does it mean now to be a Tesla owner?
Well, that's a good question. I mean, there was definitely, it's actually surprisingly hard to quantify, but it almost for sure, if you want to think about who bought a Tesla, it would be somebody living in the wealthy suburbs of New York or San Francisco or LA, who was highly educated, high income, but also socially liberal. It's an electric vehicle. You're helping the environment. You're part of the future, that's now saying, well, I'm helping make money for Elon Musk is not going to appeal to that sort of person. There are wealthy people who buy luxury cars who don't have those concerns, but they probably weren't buying Teslas, and they probably aren't going to start buying Teslas now because electric vehicles and saving the planet isn't their thing.
And especially now, perhaps when people look at a Tesla, they don't necessarily think that anymore. It is very hard to separate the man from the brand, especially as he has become more vocal. I do want to ask about your comments. You've said that we're living in an era of petulant oligarchs. You've called Musk an insecure billionaire. Does it really matter at the end of the day for his brand?
Well, it's, at the end of the day, meaning 15 years from now, it probably doesn't matter because or put it this way, even if Musk had been everything that his fans imagined him to be, 15 years from now, Tesla was unlikely to dominate. But it's got to hurt now. I mean, these are, it's kind of weird. We live in this high-tech age of all this stuff, but the probably personality, celebrity, image has never mattered more for business. I don't think that anybody who was buying a Chevrolet during the hegemony of General Motors thought much about what kind of a person Alfred Sloan was, and even Henry Ford was a character too. But still, the point is that we live in now. Maybe it's because we're a rich country and we're talking about semi-luxury goods. So the image of the figurehead for the company matters quite a lot. And boy, Musk is not doing his business any favors.
I mean, and certainly when you look at some of the tweets, some of his reactions to criticism, sometimes, it's great to get that direct reaction from a CEO, because sometimes if a story comes out, he's quick to correct it or add some nuance to it. But then some of the responses have ranged from sort of immature to spiteful as well. When you think of that picture that he paints for a brand like Tesla or some of his other companies, SpaceX, Twitter, and then you have this Twitter distraction, this idea of a distracted CEO, when for some people he can just do no wrong, he's a genius. What lens should we be viewing Elon Musk through?
Well, I mean, it's got to be a bad thing. I mean, to a certain extent, for him to be highly visible was a good thing for the business. And look, there are two kinds of people who send me hysterical hate mail. And usually it's not strictly political. There's crypto types and there's Tesla fans, Elon Musk fans. Certainly having that fan base was in some ways a good thing, but it clearly can turn into a liability. And I have to say, I don't really understand it. I mean, if I had that much money, I really wouldn't much care what other people thought of me. I wouldn't be responding to random. Well, I personally, if I responded to every random nasty thing somebody said on Twitter, I would have negative 30 hours in the day, and it's really amazing. But in any case, it's not a good sign. All the signals are exactly what you don't want to see in somebody who should be, like you said, laser focused on building this business.
And so then when you look at some of this really core sort of diehard fans that support Musk, that doesn't necessarily mean that they're the ones buying his product. So if you could give him a message as to who he should really be listening to at this point, because it does seem that he is revealing more of himself with every single tweet and every single reaction.
Yeah, well, the trouble is I'm not sure that there's useful advice to give. It would be one thing if he were acting out of character and you could say, go back to the guy you were. This is probably who he always was. And what happened is that he got himself, wealth, and then the purchase of Twitter empowered him to sort of reveal more of his true self. And it's very hard to go back on that. I mean, I suppose it would, if he were to actually go quiet about QAnon-ish stuff for a year, people might forget about it. But this is, it is amazing. I mean, I've never, and he isn't the first super rich head of a highly innovative company to kind of go off the deep end. Henry Ford promoted the Protocols of the Elders of Zion. He was a crazy conspiracy-minded anti-Semite, but they were different times, and it probably didn't matter as much, and now it does matter.
Well, that was Nobel laureate, New York Times columnist, and distinguished professor of economics at City University of New York, Paul Krugman there. Obviously, some very interesting comments from Krugman there, Brad. He did raise a good point about the sort of cult of personality, because how many of us think of, when we buy a jacket or something, about how the CEO's tweets or their feelings about things affect our ability to buy it? But Musk is he's a very different CEO, and people have a very visceral reaction to him.
And here's the thing, for a lot of time, especially given what he's kind of brought into the broader fold in the industry and automotive landscape, is this idea of how an electric vehicle can be sexy. I mean, just look at all of the different names that he tosses on his vehicle. It's the S, it's the 3, and you turn the 3 backwards, what do you got, an E? He's got the X and the Y. And so all of that, he's tried to make it more sexy to have an electric vehicle. He started at the very kind of luxurious end of the market there, and then for how different he's been as a CEO, I think investors very much gravitated towards the stock in some cases because they saw the value attribution to having Elon Musk as a CEO. You had a CEO and a chief marketing officer all packaged up into one. And so with how he had been valued for many years and how he continues to be a major factor within Tesla, that is going to be a lingering question mark when you do have some of the succession planning that is necessary to take place for a company as large as Tesla as well. And so that perhaps something that investors will be paying close attention to in the future. But for as of right now, no clear indication of who that next person would be. But we've got to leave that conversation there because coming up, we've got a busy period when SpaceX sent the Falcon Heavy into orbit at the back end of 2022. Guess what? That was the 50th launch of the year. This week, it had 4 orbital launch pads all loaded up for the first time ever. So does this all need a CEO's full attention? We discuss the final frontier next.
Elon Musk's SpaceX was recently valued at $137 billion after kicking off the year with a fresh round of funding. The world's top space group has seemingly gone from strength to strength since Musk first launched it 20 years ago in a bid to reduce the cost of transportation in the final frontier. And the big question these days, when is it going to go public? And will it be the best way to invest in a booming sector? Well, joining us now to help make sense of it all is Deutsche Bank space research analyst Edison Yu. Good to see you, Edison. Now, by some estimates, at least according to some sources at CNBC, we might not see them going public until 2025. But how much of a game changer do you think this would be?
Yeah, thanks for having me on, and Happy New Year. So I think a few things there. Right now, you don't really have any big player in the public markets for what I call new space. And the leader of all this is unquestionably SpaceX. So it's going to have, I think, a big positive impact when it does go public, because it brings a lot of investors who probably didn't look at a nascent sector like space into the equation. It forces them to do a lot more work. It takes notice. And I think overall that will lift space stocks, and especially new space stocks in general, across the board if they do that.
And Edison, I mean, when you think about the number of investments that are being made in space right now, what are we going to continue to kind of see and expect, even here in 2023, when some of those dollars have seemingly, at least seemingly because of 2022 and the absence of that just cash flow into the more experimental parts of investing, where do you believe that will rebound?
Yeah, so I think two things there. One, we saw a pretty vicious sell-off in the public listed space stocks in 2022. I mean, you can run down the list. You're talking, 50, 60, 70% drawdowns. And especially in December, you saw that probably exacerbated even further by some tax harvesting, some window dressing and beer. I think this year that does change quite a bit. And the reason is because you're going to have several companies such as Planet Labs, Rocket Lab, that are generating real growth, that are seeing margin improvement. And these will cause investors to take another look. The second development, which has been in focus, especially in just the last month, is that people are realizing a lot of these space services and space assets are very scarce. And just as an example, we had 4 rocket failures in the last month, ranging from 2 in the US, 1 in Europe, and 1 in China. And that just shows you that getting assets, important assets into space is extremely difficult and is actually a increasingly scarce commodity. And as we all know, as we all seen over the past year, scarce commodities tend to go up in price. And I think you're going to start seeing some of that dynamic with these space stocks as the year progresses.
And Edison, speaking of scarcity, we know that Europe increasingly turned to SpaceX after sanctions on Russia over its invasion of Ukraine, and really highlighted their reliance on some of these Russian rockets. How has this strengthened SpaceX as their position? And what does this mean if you have other tech companies also getting into the mix as well?
Yeah, I think that's a huge part of the strength of the rocket business, the launch business of SpaceX. Essentially, most countries and big corporations right now, they have nowhere else to go. If they want a large rocket that can reliably fly to orbit, you're pretty much stuck with SpaceX. And I think the most obvious example of that is OneWeb. OneWeb is actually a competitor to Starlink, and yet they've flown 2 missions already to get those satellites there because of the Russia-Ukraine situation. I think that dynamic will only actually get more intense. You've seen the European launch vehicle Ariane 6 get delayed. ULA looks like they might finally be coming online with Vulcan, but that's been delayed. We've had a bunch of startups, as I mentioned earlier, have failures and delays. So that dynamic, I think, absolutely continues to be front and center, and SpaceX is by far the biggest beneficiary of that.
Edison Yu, Deutsche Bank Space Research Analyst. Edison, thanks so much for the time and the insights and analysis. We got to leave things there for the day. Would love to have you back and continue this conversation. Switching gears here, but kind of staying with SpaceX. SpaceX is just one of the many companies that Elon Musk is in charge of. Joining us now for a deeper look into his empire, we've got Yahoo Finance's Dave Briggs live in living color in the studio. What's going on, Dave?
Good to see you, buddy. There's a lot going on with Mr. Musk, to say the least. Distracted is probably the one word that characterizes it best. Far too many potentially life-altering projects for Elon Musk. So how best to define him? Well, perhaps through his favorite lens, which is the project consuming his time, his passion, and his energy in one 280-character tweet. To do so, I had to enlist today's top tech, which is ChatGPT. Here's what they came up with. Quote, Elon Musk is a South African-born American entrepreneur and business magnate known for founding companies such as Tesla Motors, SpaceX, Neuralink, and The Boring Company. He's also known for his ambitious plans to colonize Mars, revolutionize transportation with the Hyperloop, and bring high-speed internet access to remote areas via satellite. He is often considered a visionary and a pioneer in the tech industry. Well done by ChatGPT, but ironically, they failed to mention, and many don't know, Elon Musk is also a co-founder of ChatGPT creator OpenAI. The world's second richest man is, however, preoccupied with what Wedbush analyst Dan Ives calls one of the most overpaid tech acquisitions in history, that, of course, being his $44 billion Twitter buy. In less than 90 days, he's gutted the place of employees and sent advertisers fleeing as well, all while watching the driver of his wealth shed 65% of its market cap in 1 year. While Teslas themselves are still struggling to be fully autonomous, his other businesses are required to essentially drive themselves. SpaceX hasn't quite colonized Mars, but it was valued at $137 billion, a true rocket ship of future wealth creation. On the opposite end of the earth, though, Boring Company. They once promised to end traffic as we know it. Instead, its signature accomplishment is a $47 million tunnel that one human driver takes 3 passengers 1 mile from the Vegas Strip to the convention center. Neuralink. Well, they promised to transform communication with human brain implants in 6 months. As the monkey could tell you, there's only so much that can go on and fit in one human brain. The wheel that drives Elon's wealth is, of course, Tesla. And while Elon has unveiled the Semi, teased the Cybertruck, and even marched down a humanoid robot, he's still essentially stuck in neutral with just 2 models, really. The Model Y and the Model 3, while Ford and GM continue to expand their product line in essentially every direction. With every new day, there's a new Twitter proposal from Elon, the latest being auctioning off Twitter handles. In case Elon wants a ghost account, Brad, he might consider registering at The Distracted CEO. He wouldn't have to pay for it because it is actually available right now. Distracted is the one word that characterizes his entire empire at this junction.
And Dave, with that breakdown, it really does boggle the mind just how many things he has on his plate while he still has the time to tweet. But as you mentioned, there's some life-changing projects that he's working on there. Big thank you there to Dave Briggs. All right, coming up on what just happened, Elon Musk is no stranger to getting himself in hot water on social media. We look at some of the tweets still causing him trouble today. That's next. Well, let's get a check on what we're seeing with Tesla's price action heading into the noon hour. We see there the stock off there about 3.5%. So obviously a lot of people wondering what this means with these price cuts that they've had, what this means for the broader industry, and what this means for Tesla's future as well. Well, that'll do it for now. I'm Rochelle Akutha, along with Brad Smith. Thank you for joining us. Have a great weekend, and we'll see you on Monday at 11 a.m. Eastern.